the direction of travel, things look great right now.
We're entering this phase of AI application.
AI is not a bubble. I think it's still a boom and a structural change. And that's why we are constructive for next year.
AI is certainly going to change the world. But who are going to be the winners in that?
You can look at either side of the coin on so much of the data that's out here, and you could either be bullish or bearish.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome to Bloomberg Surveillance. Stocks range-bound as traders curb their enthusiasm about Fed rate cuts, with U.S. yields rising to the highest levels in almost 3 months. Macro analysis giving way to boardroom drama with Paramount's hostile takeover bid for Warner Brothers, setting the stage for a new chapter in the media landscape. And NVIDIA notching a win with President Trump signing off on sales of H200 chips to China. If we sell it, will they buy? I think, Annmarie, that is the ultimate question.
That's a great question, because over the summer, remember, when the administration gave the green light for the H20 chips, China told their firms, do not buy these chips. We are shrugging them off. This morning, just moments ago, the Financial Times is reporting about how Chinese regulators are discussing ways to limit permits for the access to the H200 chips. Buyers need to go through an approval process. So basically, maybe some Chinese companies can buy them, but not all of them. Because remember, China wants to make sure that they have their own national champion.
You know, this really is notable because you saw AMD shares rally in tandem with NVIDIA last night as this was announced. And it raised this question, is the concept of national security changing at a time where this administration is taking a greater clutch over corporate America than ever before? Is there a sense that there is more of a risk for U.S. tech companies not to have a presence internationally than to potentially sequester some of the high-tech technology away from China?
This is a live, active debate right now at the White House. Individuals who think you need to get the world addicted to U.S. technology, and others who think you cannot give China an inch when it comes to the most advanced chips, when it comes to national security, because it's not just iPhones that these chips go in. These are used for the military. This debate is active, and at the moment, it looks like the tech sector, especially Jensen Huang, who was just in Washington, D.C., is winning this debate. And I think for a lot of people, especially China hawks in Washington, who really backed the president in 2016 because they liked his rhetoric on China, are thinking this is a huge pivot.
Well, right now, a huge pivot also for the media landscape, and this is something that we keep watching. It will be the Game of Thrones that everyone is looking for the next season. The idea that Paramount coming out with a hostile bid to take over Warner Brothers after Netflix's offer. Some of the characters behind this are just pretty impressive. The idea of Jared Kushner, of Abu Dhabi, of Saudi Arabia, all lining up to get behind David Ellison, who is saying to shareholders, look, vote for us because we have the sign-off from President Trump. How much is this ultimately? Who gets the blessing of the president in order to carry this through the antitrust?
The president is being quite coy. Yesterday he said none of these individuals are really my friends, which you'd have to think for his son-in-law, Jared Kushner, that one potentially was a dagger in the heart. But when it comes to Affinity Partners, his private equity firm, and some of these sovereign wealth funds, yes, they're there showing up with the backing and the capital, but they will not get a seat on the board, which is why the Ellison family thinks in the end they can get regulatory approval for this. But this doesn't look like it's going to be ending. Of course, Warner Brothers, now valued with this Paramount deal $108 billion, they're going to have 10 days, I believe it is, and then Netflix will have another 4 days. This can potentially become a fight, and I think this is classic Trump. The same way we see him pick, say, a Treasury Secretary in the Game of Thrones, War of Roses, Bachelor, however you want to call it, he's almost putting himself in the middle of this, and he thinks that it should be the best deal for Warner Brothers. Let's see.
Yeah, the other drama is barbarians at the gate. Right now, the drama is also heading into the Fed meeting that starts today, ends tomorrow with a rate decision. Taking a look at the drumbeat to that, we get the JOLTS job openings data coming out at 10 a.m. Eastern. Then later today, we do get some auctions, as well as heading into tomorrow, we get ECI, we get Oracle earnings, and that Fed rate decision, and then jobless claims coming on Thursday. Right now, futures little changed after breaking their 4-day winning streak yesterday. Really, it is all predicated on the yield space, the idea that yields are rising. Today, we're seeing a little bit of a reversal after another 2 basis point sell-off increase in yields. Given the fact that we're looking at yields that are hovering near the highest levels going back to September, Is this because of the Fed, or is this despite the Fed, given the geopolitics and the global landscape? Coming up this hour, John Stoltzfus of Oppenheimer, with stocks looking for direction ahead of a key Fed rate decision. Wendy Schiller of Brown University as President Trump ramps up his affordability message. And Port of Los Angeles Executive Director Gene Seroka on how tariffs are impacting global trade. We begin this hour with stocks holding steady as investors look ahead to that two-day Fed meeting. John Stoltzfus of Oppenheimer raising his year-end price target on the S&P 500 for 2026 to a street high of 8,100. Once again, the biggest bull on Wall Street, writing monetary policy, fiscal policy, and the continuing progress of innovation and corporate earnings growth are key to growing earnings and revenues in the year ahead. John joins us now. John, you have been the biggest bull and you have been right. Why do you think this time people are getting it wrong about how accommodative both monetary and fiscal policymakers are going to be?
Well, I think, Lisa, the big thing is, we're in a process of normalization of interest rates coming out of a hike cycle, and a remarkable hike cycle because the Fed raised rates 11 times, on pause 14, with only 5 cuts in this whole process, but no recession. Brought inflation growth down from 9.7 to, based on the PCE last week, sometime between 2.8 and 3. So, it looks pretty good. It shows sensitivity for the dual mandate, a balance. There's a bit of a walking the tightrope for Jerome Powell, but I think he loves it. He's a real pro. And I think, he's got to walk the tightrope here to give you a little bit of balance so we get enough stimulus for the economy, essentially, for sustainable growth without upsetting the job cart terribly, and we moved forward. And around the world, we've seen interest rate cuts, and now the thought that maybe it's gone too far. I think this is a lot like different that it's got the override of the Bernanke legacy, high transparency, communications in its policy, the way the Fed operates, but we're looking for that normalization, and inflation tends to be stickier for longer after you've had a period of untoward levels of inflation. It takes a while to work out in the system, and it's a drama that traders and investors need to work out and play to their benefit.
Right now, the drama is playing out, and you are seeing people ratchet back their expectations for rate cuts next week to now next year to now 2 rate cuts from 3 just a couple of weeks ago. I am wondering, though, how much that matters versus the AI trade. I mean, there was a recent Goldman Sachs survey of investors, and they agree with you on the basis that you will get Fed rate cuts, but they disagree that you're going to get that kind of screaming return because the AI trade is hitting some roadblocks and isn't in hyper-growth mode. How much do you buy into that?
It's some of that sounds to me like the trading establishment in a way, because it's the action where can you add bips to the bucket, in trading, working with the spread on the daily basis. I'd have to say this is not uncommon. I mean, there's always questions. You have to invest a lot of money to do what this proposes to do, whether it's the data centers, whether it's all the ancillary software and the design changes to be made. But the companies that are doing it are very well positioned in terms of their balance sheet. And when they borrow money, it's probably because they rather keep the cash on the balance sheet and just use other people's money, OPM, other people's money, the old thing from the old days, right? And so I look at it, it looks, to me, AI is for real. I think whenever I talk to people who are institutional users, and I don't mean just in finance, but if it's healthcare, consumer discretionary, insurance, what have you, people are using AI, and the consumers are using it either for fun or just to shock each other what they can do with GPT, whatever the heck it's called. You know what I mean? Where they put your face on somebody else, and you're running down the street crazy.
What you look like is a 130-year-old.
There you go. And the whole thing is, it's just not uncommon. It just looks to me like, and haven't I been here before? But the wonderful thing about this, in a digitalized environment, the market tends to discount both good news and bad news fairly quickly. And that's what gives us this effect of one day the traders own the market, the next day it's intermediate and long-term investors as they buy up the babies that got thrown out with the bathwater the next day. Then they visit mids and smalls, then it's a rotating market. But it discounts good news and bad news more quickly because the digital news travels faster, it's quicker to analyze, determine, and the play is on.
John, we got, in terms of the play is on, NVIDIA is getting the green light to sell the H200s in China. When you look at that decision by the administration, does it say to you that in 2026 trade tensions are going to be a little bit more quiet than they were this year?
That's a tough one to say, because when it comes to trade tension, it seems to be just part of the way things work with the current administration, but likely would also continue on with any other administration, because that's the way President Xi operates also. There's a balance between fig leaf and the axe. It's a constant. This is a game of chess, and it's not a friendly one. But ultimately, both sides want trade, because peace is more profitable than building war machines and battling each other. Look what's happened to Russia financially, really, when you look at what the cost of doing what they've done to Ukraine has been. And on the other hand, if you play with your financial partners nicely, and you compete, you produce better results for your own people, and you also improve for China, it would be the Silk Road and the success of that, the competition that's occurring then, and what is felt by other emerging markets. It's just, this is the way things work. But the tension, it's like they often say the market doesn't like uncertainty. It loves it. The traders love uncertainty. Both sides can benefit. Intermediate to long-term investors, again, babies that get thrown out with the bathwater. The traders looking for the bips, a new vanity plate for the trophy car.
Yeah, and maybe bonfire of the vanity play. I am curious going forward about how much you see this rotation as durable, given the fact that you still see the AI stalwarts as really having a lot of the strength. Are they going to keep leading, or do you think that there is this durable shift? That's
a great question, and I think what we have seen since 23, and many people deny it, has been a broadening of the rally, with other sectors sharing the stage with information technology and communication services, which is where the streamers and the social media and the search engines are, as well as the old phone codes. But when you look at it, you're in a situation where other sectors like financials, industrials, healthcare, utilities are beginning to find interest by investors. Greater diversification in portfolios, to benefit from the other 9 sectors that can benefit from technology. Any company that wants to keep a competitive edge needs AI. Any company that wants to gain a competitive edge needs AI. Any company that just wants to maintain a good premise is a value company to attract and maintain investor loyalty needs AI.
Yeah.
It looks like into the future. It's here we go. What is it? Back to the future.
Yeah.
Here we go.
I'm going to have that soundtrack in my head all morning. John Stoltzfus of Oppenheimer, thank you so much with Into the Future. All right now let's get you an update on sales stories elsewhere this morning. No one has to listen to me sing. Here is your Bloomberg Booth with Yahira Anand. Yahira.
Hi, Lisa. President Donald Trump granted NVIDIA permission to ship its H200 AI chip to China in exchange for a 25% cut of the sales. The move means the world's most valuable company could regain billions of dollars in lost business. President Trump says the sales would only go to, quote, approved customers, and that chip makers such as Intel and AMD would also be eligible. Meanwhile, Paramount Skydance launching a hostile takeover bid for Warner Brothers, the move coming just days after the company agreed to a deal with Netflix. The offer stands at $30 a share in cash, compared with Netflix's cash and stock bid of just under $28 per share. President Donald Trump, whose son-in-law Jared Kushner is participating in the Paramount bid, saying he's not close to Paramount nor Netflix. And PepsiCo announcing a series of operational changes backed by activist investor Elliott Management. The moves include cutting nearly 20% of its U.S. product lineup, investing in more affordable products, and layoffs in North America. Elliott says the plans will drive greater revenue and profit growth. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Yeah, the activist influence over Pepsi going to affordability. Everyone seems to be looking for that. Value, affordability. We hear that from every company. We're hearing that increasingly from the administration.
Because the consumer is demanding it. They're demanding it in polls, and they're demanding it when they go and they're shopping.
Yeah, up next, we're going to talk about that, all about affordability.
My administration and our partners in Congress will continue our work to lower the cost of living and make America affordable again. Affordability, they call it, was a con job by the Democrats. We did a great job on groceries and affordability. The only problem is the fake news.
Wendy Schiller of Brown University joins us next to talk about that. Right now, future rates fluctuating as that meeting does start to take place in Washington, D.C. with the FOMC. This is Bloomberg Surveillance. looking for direction ahead of a Federal Reserve meeting where people broadly expect there to be a rate cut. But the real question is, what will the signal be going forward? Right now, you're seeing just a fluctuation in futures. After yesterday, we saw a 4-day winning streak snapped. Meanwhile, yields inflected downward just a little bit after a losing streak in terms of yields higher that has sent yields close to the highest levels going back to the end of September. A real question of how much more the Fed can actually cut rates. Very much front and focus for all of Wall Street is this boardroom drama that is going to turn out to be the blockbuster of the year. A question of Paramount's hostile bid for Warner Brothers after Netflix came out with a $27.75 share in cash and stock bid for Warner Brothers. Paramount came out for $30 a share in cash. Some of the players behind this just really eyebrow raising when it comes to trying to curry favor with the White House.
Oh, absolutely, especially Affinity Partners, which is part of the Paramount bid. Of course, this is led by the president's son-in-law, Jared Kushner. He did tell reporters yesterday he hasn't spoken to him about it. There's also the sovereign wealth funds of Saudi Arabia, the United Arab Emirates. Qataris are involved in this. What's going to be critical for whoever gets the green light is the regulators. What are they going to say about, as you say, the characters that are involved, but also the market share and what this means? Paramount thinks that because Netflix has already such a stronghold in the streaming sphere that they're going to be able to get that green light. Remains to be seen. Whoever buys it needs to make a movie about this deal.
Well, I think that would be probably the next blockbuster. Right now we're looking at breakup fees of $5.8 billion for Netflix and $5 billion by Paramount. So someone's going to get paid quite a bit of money. Getting paid is key and front and focus for a lot of Americans as affordability concerns come front and center. Under surveillance this morning, all about affordability.
My administration and our partners in Congress will continue our work to lower the cost of living and make America affordable again. Affordability, they call it, was a con job by the Democrats. We did a great job on groceries and affordability. The only problem is the fake news. There's this fake narrative that the Democrats talk about, affordability. They just say the word. It doesn't mean anything to anybody. Just about everything is down. You know, this whole thing is, they use the word affordability. It's a Democrat hoax.
Here's the latest. President Trump traveling to Pennsylvania later today to promote his economic agenda as more polls show affordability is the dominant concern for Americans. Bloomberg's Tyler Kendall joins us now for more. Tyler, great to see you. What are we expecting to hear from President Trump today?
Yeah. Hey, Lisa. Good morning. Well, we have to keep in mind this really marks the first big domestic policy speech for the president that's going to be focused on the cost of living after Republicans suffered a slew of election losses last month that really put the issue front and center. And it's important context here. We have to keep in mind that President Trump really campaigned on the issue of the economy. It's what helped propel him to the White House. But as you mentioned, recent polling and data, including consumer sentiment, while improving, is still around record lows. And I'll even point you to our own Harris poll conducted from Bloomberg News in October, which showed that 55% of Americans that are currently employed are concerned about losing their job in the next year. Now, President Trump is going to tout those policies that we've seen him roll out in really the last month since Election Day. That includes that investigation that was launched over the weekend when it comes into the food supply chain. President Trump signing that executive order directing the Department of Justice and FTC to look into alleged price gouging and unfair trade practices. He also yesterday, of course, rolled out that aid for farmers, and we're also expecting him to talk about some of the policies that he's put forth but have yet to be implemented, such as his tariff rebate checks. Though, of course, we know that that does face some pushback in Congress. And Lisa, there's another issue from Congress that could complicate matters for President Trump. That's the current debate over the path forward when it comes to health care. Of course, we're coming up on the end of the year when those Affordable Care Act premium tax subsidies are set to expire. And right now there is still big debate, but not really action on Capitol Hill on exactly how they could address what could be a steep hike in prices for Americans if we go over that cliff. Now, Lisa, I'll also quickly add, expect more of this from President Trump. It's our understanding from the White House that he's about to go on a big domestic policy push around the country.
Tyler Kendall, thank you so much for that. And one of those big domestic pushes might be some reporting from Politico this morning where President Trump may make tariff changes to lower some prices. Wendy Schiller for Brown University joins us now with more. Wendy, thank you so much for being with us. I just want your take on some of the focus on affordability and whether you think it will resonate given some of the proposals that are on deck.
Well, I mean, I think President Trump realizes that he is losing a little bit of his grip on the House of Representatives in terms of his power over the GOP. He's still a player in primaries. So we've got another 7-month window, give or take, for the Republicans to face primary challenges. And that's where he gets his leverage. But you can sense that the House, is, particularly GOP, really worried that this affordability or economy or inflation or prices will cost them control in the House and even possibly the Senate now. So I think that's the real overlaying issue here is what do you do symbolically as the President of the United States? Because, we all know all presidents have a tough time getting a handle on prices and inflation. But what do you do that reassures Congress? Because if, in fact, he loses his grip on the House of Representatives this early, then he really enters uncharted territory in terms of his power to get anything done.
Symbolic, of course, is going on a tour domestically. They're also floating $2,000 tariff dividend checks. Wendy, do you think we're going to see that?
Well, Annmarie, it just immediately brought to mind the stimulus checks during COVID. And of course, we had multiple checks, Trump and Biden. And much of that, in terms of commentary, was thought to increase inflation. In other words, not good for the economy and making things more expensive. So I'm not sure that's going to fly with consumers who remember that, but also the base of the Republican Party that voted for Trump that thinks government gives away too much money to begin with. Do you get these deficit hawk conservatives in the House to give away more money? And, making the connection between the revenues gained by the tariffs, our very large deficit, our national debt, and then giving away government money, it just seems like it's a package that will be difficult to sell to conservative Republicans in the House, but also to their constituents.
There's a lot of talk as well that there's going to be a number of Republicans that retire from Congress. How difficult is that going to be as the president tries to tout this affordability, the economy is working ahead of the midterm elections, but a lot of Republicans seem to be wanting to get off the ship?
Right. So there's a record number of Republicans who are retiring going into this midterm at the moment. It's not a record number overall of members of Congress. I'm watching the next couple of weeks to figure out really if there's going to be even more Republicans that walk out the door. If they can't get any kind of compromise on extending these subsidies. And the president has basically indicated, even though, it depends on the day, he'll sign it. If they give him an extension, he'll probably sign it. So if they don't do that, then these Republicans have to go home and they're in fact going to face constituents who are paying a lot more money for health care. And do they really want to face that onslaught? So if they fail to get a deal, my instinct would be that more Republicans would walk out the door, makes it much harder for Speaker Johnson. And then you've got people like Marjorie Taylor Greene who are, who's leaving, who's then on the outside and who can do nothing but criticize the inside. So the pressure ramps up on the Republicans in the House, and that I think makes it harder for President Trump. The farm subsidies remind me of the first term, $16 billion, I believe, in the first term to farmers because of tariffs. Now we're looking at $12 billion that you can argue is an unnecessary expense due to Trump's tariff policy.
And there's a question of whether the tariff policy will actually remain in place altogether, given some of the recent proposals. Wendy Schiller of Brown University, thank you so much. Picking up on that Politico interview with President Trump, a lot of information there in terms of just his agenda going forward, what he thinks about affordability, about Ukraine, as well as the Federal Reserve and the potential pick that he already seems to, Annmarie, have selected.
Oh, he says he has it in his mind, but then he did call the frontrunner, Kevin Hassett, a potential Fed pick. In this interview, he says he thinks Jay Powell is not a smart person, doesn't like Trump. And the reason he doesn't like Trump is because I hit him hard because he's doing a bad job on interest rates. But he didn't give a name. He just kept talking about we're fighting these interest rates. It's interesting because obviously the Fed is meeting today, but he didn't give a name on who that person is in his mind that he's already made that decision on.
Meanwhile, Wall Street has a short attention span and it's shifting very quickly to the AI story away from the Fed chair drama. A real question of what national security means in the case of some of the high-tech chips coming out of the likes of NVIDIA. Coming up, we'll speak with Bloomberg's Mark Bergen as NVIDIA gets the green light to sell those H200 chips in China. Plus, Danny Berger with your morning movers. We'll be taking a look at NVIDIA shares, which are rising after that approval. Right now, they're basically unchanged. This is Bloomberg Surveillance. Looking for direction after snapping a 4-day winning streak. We're looking right now at markets that are grappling with the concept that maybe yes, the Fed will cut rates in the two-day meeting that begins today. But no, they will not continue cutting rates aggressively next year. Now just 2 rate cuts priced in for the entirety of 2026 are basically range-bound across the board, except for the Russell 2000, once again eking out an outperformance with a 0.2% gain. When you take a look at 2s, 10s, and 30s, a bit of a reprieve after a pretty violent sell-off. What we are seeing at the front end is just meandering, really has been hovering around that 360 point, 358 right now on that 2-year. 10-year yields near the highs since they've been going back to September after a pretty vicious sell-off, 415 on that 10-year, and 30-year yields also getting a little bit of a bid down from the 4.8%. Take a look at Home Depot shares, pre-market trading right now. Those are lower by about 1.4%. It is Investor Day for the home goods retailer, offering some cautious preliminary guidance for next year without really seeing a revival in the housing market.
Right. So there's two things. Even though some mortgage rates are lower, they're seeing that less and less families are able to get on the housing ladder. And then even if families have a home and they want to refurbish and do work on construction, they're not able to do it right now just because of the state of the economy. And it comes back to what we were just talking about, Wendy Schiller and Tyler Kendall, about this idea of affordability. So right now they just expect comparable sales growth to be in the range of flat to up to 2% for the year. It is their investor day, so they do have a very rosy picture, but we would need to see the housing market turn for that.
Which is the reason why after about 10% losses so far this year, you're seeing additional losses in pre-market trading. 3 hours away from the cash open, here are your morning movers with Danny Berger. Danny.
Hey, Lisa. Starting with NVIDIA, after President Trump posting on Truth Social that he will allow the sale of H200 chips to China, those shares now little change. They were up as much as 1%. So maybe some questions now being asked in just how this will work. The Commerce Department telling Bloomberg that it would work via the form of a 25% tariff. That's what the revenue share that the U.S. wants with NVIDIA when the chips get shipped from Taiwan to the U.S. for inspection. So again, NVIDIA, little change this morning after moving significantly higher. One share that is moving to the upside is Ares this morning. This is about the time of year when we get a reconstitution of the S&P 500. We learn who's being added and subtracted. Ares is being added, so shares up 8.2%. It gets a lot of passive flows with that new addition. And Kellanova is being booted out for the sake of Ares. Just shows the growth of these private capital players entering the sphere. Finally, you mentioned Home Depot giving their cautious outlook. We also had a cautious outlook from Toll Brothers. This one's significant because Toll Brothers is one of the rare home builders that has outperformed. It has a more luxury customer base. Its homes on average are about $1 million, but its outlook disappointed. The CEO saying that they're confident, but did so cite that they have softness basically in many, many markets. So shares off by 4.5% in the pre-market, Lisa.
Thank you so much, Danny. Really notable given the fact that they tend to be the most resilient amid sort of a K-shaped economy. On our radar this morning, Paramount Skydance launching a stunning hostile takeover for Warner Brothers Discovery. Paramount's bid of $30 a share all-cash offer comes days after Netflix agreed to buy Warner Brothers in a cash and stock deal just under $28 per share. So not exactly apples to apples in terms of comparing the price, given the fact that, yes, it's a little bit less than $28 a share, but it does include some of the properties that include sort of the news and sports versus the $30 all-cash offer.
Right. Netflix is just going for the studio and the catalog. And then what Paramount wants is everything. They want to include CNN, TNT, and some of that live audience. So it's a little bit hard to decipher exactly what deal. It's difficult because, as you say, it's not apples to apples. I think part of this comes down to how Warner Brothers decides, do they want to spin off the news before they sell the remaining entities, or would they rather sell it as a whole? And it seems like, based off all the reporting, the Wall Street Journal has a ton of reporting about this, about the text messages, the visits to David Zaslav's Beverly Hills house. It does seem like they felt like they were getting ghosted. That's the word that the Wall Street Journal used. Larry Ellison, David Ellison, the Ellison family felt like they were getting ghosted. And it seems like the Warner Brothers C-suite already decided they were going to Netflix.
Yeah, well, David Ellison doesn't like being ghosted. Now he's bringing in some of the
Definitely
big guns
not.
when it comes to the White House and saying, look, we're going to get regulatory approval. It is all about regulatory approval. The EU launching a new antitrust investigation against Google, the probe centering on the company's alleged favoring its own AI tools, as well as failing to compensate content creators for materials used in its AI results. This might be the key between the U.S. and Europe. It has to do with regulating the U.S. tech sphere. How much is this going to be sort of sticking a finger in the eye of some U.S. negotiators?
When we saw a similar probe in September, the president came out and he said it was discriminatory. Obviously, there has been a lot of sharp rhetoric from this administration when it comes to the European Union, their regulation of a lot of these tech companies, which is why the second that Trump won, you saw all the tech companies going down to Mar-a-Lago and talking to him about we're going to need help when it comes to Europe, whether it's regulation or the digital services tax. We are just getting news as well from the EU Commission saying they did give the U.S. administration about the Google antitrust probe. So trying to get ahead of it. But this is going to be another big point of friction between Brussels and Washington.
Yeah, which is an ongoing negotiation. Meanwhile, talking about negotiations, President Donald Trump granting NVIDIA permission to ship its H200 AI chip to China in exchange for a 25% profit cut. The policy will limit sales to approved customers and is applicable to other chip makers, including Intel and AMD. Joining us now for more is Bloomberg's Mark Bergen. Mark, thank you so much for being with us. So how big of a surprise was this, given that it is a reversal and it comes over some of the pushback from even people within President Trump's administration?
Yeah, it's a reversal. I mean, it's definitely something that Jensen Huang, the CEO of NVIDIA, has been arguing for a long time, making the argument here that this restriction basically gives Chinese companies, particularly Huawei, a big edge. And there are people, as you mentioned, in the Trump administration that have argued against this. There are those that have argued for this, using terms like they want to get China addicted to American chips and American AI, something that the U.S. can have control over.
Do we have a sense, Mark, if we sell it, will they buy? Do we have a sense of whether China is going to sign off on some of their big tech companies using NVIDIA chips?
That's a big question. I think an outstanding one. There's some reporting in the FT this morning that Beijing is going to restrict that. We've seen restrictions on the H20, which is sort of an earlier version, less powerful version that has been sold, permission to sold into China. I think that's the ultimate question, right? The concern here from Chinese side is that they also want to build up their own industry. You mentioned Huawei. There's also several other chip competitors trying to catch up to NVIDIA. And one way to do that is to have these large Chinese tech companies and startups buying their stuff.
Mark, can you talk to us about actually how this will work? Because in its exchange for basically a 25% tariff.
Yeah, I mean, I imagine that's also the response inside NVIDIA right now, is I think trying to make sense of the actual details in here. The devil's in them, of course. I mean, the prior agreement had a 15%, and now we have 25%. I imagine there's a lot of back and forth. I imagine there's a lot of lawyers involved. But this is something where the company has clearly, China is a really big market, and certainly the signaling and the messaging from Wang and his executives there is it's a place that they want to be in.
So even if they have to play a 25% surcharge, what you're saying is for NVIDIA, it still makes sense. What kind of money and access will they get in China with the H200 if, to Lisa's point, China gives the green light for firms to buy?
That's a good question. I mean, there's certainly, these are over a year old right now, but they are, from our reporting, about 10 times more powerful than the NVIDIA chips that China has access to now. I think there's an expectation. There are a lot of really, there's obviously the major AI tech companies, there's Alibaba and Tencent, and then there's DeepSeek and a wave of these companies that have kind of come out of nowhere and developing these models, many of them open source, that are as competitive as those coming out of Silicon Valley. I think the argument from the hawks in DC is that you're basically handing them these incredibly powerful tools to let China continue to go ahead. I think it's, there's lots of questions around the sales channel, but the big one is, what Beijing is going to allow.
Mark Bergen of Bloomberg, thank you so much for being with us. There also is a question, Annmarie, of just how much already has gotten out of the bag. The idea that there have been chips that already have been smuggled to China anyway. There's a story this morning about the Justice Department detaining 2 individuals for allegedly smuggling H200 chips out of the United States to China in the prior year, which really underpins some of the questions around DeepSeek.
So there's 2 stories at the same time. One, the Justice Department is going after these individuals. At the same time, the president is recalibrating his policy on what should be acceptable to China. It feels like they are putting economic concerns, they are putting trade concerns, and making sure they have a good trading relationship with Xi Jinping ahead of national security concerns. And with Financial Times, I think the biggest question this morning, as you've been saying, will China even allow it? And it does seem like China may allow some of it, but it's not going to be carte blanche allowance of NVIDIA back into China.
Which is the reason why you're not seeing an even bigger share pop, right? Given the fact that they did not include any sales to China in some of their forecasts. I'm talking about NVIDIA in particular. NVIDIA and AMD seeing the biggest gains. Intel, not so much because they're not going to be quite as affected. Today, we are getting a host of investor days, and I think it is important to mention this. We did get Home Depot with a real tepid outlook for next year, a question on the revival of the housing market. CVS also holding its investor day, talking about how its 2026 revenue is going to be short of some Wall Street estimates, highlighting the concern around the consumer. I mean, just want to point to this one more time. CVS coming out and seeing the low end of an adjusted EPS range from 7 to 7.20 versus the estimate of 7.17. You are seeing a little pop, but a real question here, a lack of certainty when it comes to the state of the consumer at a time where we're talking about affordability and we're talking about really how much acceleration there is with consumers that are kind of running out of steam.
We continuously hear this from the retailers. Yes, they're showing up and buying, but it's much harder. And what you hear from a lot of retailers is that, especially when you see the likes, as we talked about extensively, Dollar General, Dollar Tree, they're seeing more consumers come and try to find deals from the top end. This idea of choiceful, I know it's like the C-suite word. The Wall Street Journal is using cranky. It's a fickle consumer right now, and they are making these decisions and looking for bargains, which paints the picture why people are really unsure of what 2026 will be. And I know everyone wants to talk about these tax rebates. Potentially, there's going to be that fiscal impulse. But as some analysts have said, consumers are spending that money today when you look at the Black Friday and Cyber Monday sales.
Yeah, so right now we're focusing on just how that's affecting the different sectors. So right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahaira on it. Yahaira.
Hi, Lisa. President Donald Trump is warning he could impose new tariffs on Canadian fertilizer and Indian rice. He issued the threat at a White House event where he announced billions of dollars in assistance for farmers. The president says the U.S. doesn't need Canadian fertilizer, but Canada is America's biggest supplier of potash. As for rice, India is the world's biggest exporter, but the U.S. buys most of its rice from Thailand. Meanwhile, the U.S. Supreme Court appears poised to allow President Trump to fire a leader of the Federal Trade Commission, the decision that could limit or overturn a 90-year-old precedent that curbs executive power to dismiss the heads of agencies that Congress set up to be independent. Many of the High Court's conservative justices expressing support for an idea which holds that the Constitution gives the president broad authority to fire officials. And as you all were just discussing, Home Depot providing a cautious preliminary outlook for the next year. The home improvement retailer forecasting comparable sales growth below analyst estimates, citing the challenging U.S. housing market. Home Depot is, however, ready for a potential rebound, stating it could see 4 to 5% growth in a market recovery scenario. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahaira. Up next, the Supreme Court weighing President Trump's tariffs.
We are making a lot of money from countries that took advantage of us for years. Our deficits are way down because of tariffs. The decision of the Supreme Court's a very important thing.
Port of LA Executive Director Gene Seroka joins us next as we do see some trade fall off, but China really continuing to be strong. This is Bloomberg Surveillance. All going to be about the Fed starting today, heading into tomorrow. The Fed does meet in Washington, D.C. The expectation, a 95% chance they will cut rates. Probably more interesting, how do they message going forward, especially given the fact that Jay Powell is a lame duck Fed chair right now. S&P futures trying to claw out of yesterday's losses, up about 0.1%. You are seeing a bid into bonds as well. After a 2 basis point rise yesterday, down less than a basis point, 415.85. Under surveillance this morning, the Supreme Court weighing President Trump's tariffs.
We are making a lot of money from countries that took advantage of us for years. Our deficits are way down because of tariffs. And, we have a big decision. Hopefully we're going to get the right decision. such a big thing in the Supreme Court right now. The decision of the Supreme Court's a very important thing.
Here's the latest. President Trump signaling Canada, India, and Mexico could get hit with a fresh round of levies, with the Supreme Court expected to rule on his sweeping global tariffs before the end of the year. Jean Seroka, executive director of the Port of Los Angeles, writing, if there's less tariff and trade uncertainty, that will stabilize the supply chain. We're all waiting on the Supreme Court ruling on tariffs. Jean Seroka joins us here in New York. Wonderful to see you. I do want to start on just how much of an impact you already have seen to trade based on some of the tariff uncertainty year to date.
Oh, it's been an unbelievable roller coaster of a year. When hard tariff policy went in, importers slammed on the brakes. Then when that policy was softened and deadlines extended, we saw a real surge in cargo, up and down all year. But we wind up with about our third best performance on the container side in our history. Yet exports have really lagged behind because of retaliatory tariffs, and Asia countries, our normal trading partners, cutting deals with other countries.
So you're saying that the U.S. can't kick its importing habit, but its exports have suffered as a result of retaliation more so. Has the importing mix changed for the United States in terms of where the countries are that are providing some of those imports?
It certainly has, Lisa. Starting back in 2018 with the first round of tariffs, 60% of our business was with China. Today it's 40% and dropping. Yet we've still grown because we've picked up a lot of trade from Southeast Asia.
So isn't China just using those countries to then send the goods to the United States, transshipment?
Annmarie, I was in China twice in the last month, and in the announcement of the 15th five-year plan by the China central government, they said specifically they're not just exporting products, they're now exporting manufacturing expertise to other countries. They're investing in Southeast Asia factories and supply chains. But as far as transshipment goes, the shirt I'm wearing, the button plackets go from China to Vietnam to make the full shirt and then ship it here to New York to the retail store. So it's nuanced, it's a little bit wonky when it comes to our business, but it's not necessarily transshipping to avoid tariffs in one country.
You talked about 2025 being a roller coaster. What do you expect for 2026? How much really hinges on what the Supreme Court decides on IEEPA?
That's a big deal. But then what happens? Do we see a refund of all this money from the Treasury Department? We know Costco has stepped into the litigation arena, only one so far, but let's see what happens. There are a couple of other companies that they followed in different sectors outside of traditional big box retail. If we see a relatively calm future over the next first two quarters, because maybe some are focused on midterm elections, that could give some certainty to the supply chain. Okay, I know the ground rules, I know the prices, let's get back to work instead of all this simulation and speculation of what could be.
How much does the uncertainty favor some of the largest companies over and above some of the smaller companies that are having a harder time navigating through it?
Lisa, I think there was a distinct advantage for those who decided to front load inventory and try to mitigate the presumption of tariffs, and then when they actually went in place with all the ups and downs of different announcements. More than half of our 125,000 importers at the Port of Los Angeles are small to middle-sized businesses. They tell me directly in conversations that they struggle to pass on those increased costs for fear of not being able to compete with the larger companies. Auto parts companies trying to absorb those costs as they send product to the big three manufacturing facilities, because the alternative is potentially shutting down a manufacturing line, which could be $2 to $4 million per hour.
So is something else going on when you look at small business confidence and the fact that it hasn't recovered to the same degree that, say, the stock market has? Is there something else going on here that isn't just with respect to a consumer that's flagging, but that has to do with an uncompetitive landscape in a way for some of the companies that don't have the supply chain heft and the data that some of the largest ones do?
You're right, and I'll give you another example. In Los Angeles, a number of small companies in our Chamber of Commerce, led by Maria Salinas, tell me that I buy a lot of small parcels from Asia, from China specifically, to put in my storefront, to put in my boutique shop. Now, with the de minimis exemption removed, their prices have skyrocketed, and those folks, family businesses, are in real trouble when it comes to keeping inventory at decent prices.
So you're seeing not so much a struggling consumer, but a struggling small business sector?
I do. And folks are trying to make ends meet. They're trying to dance around all of this policy change as best they can. They're resilient. They're working hard. but it's a distinct area of concern for a lot of small businesses.
Do you think it's enough for small businesses to actually go out of business, to close shop?
Haven't seen that yet, but again, folks are worried about what they do. You've got toy importers right now who take these 6 weeks before the holidays to make payroll for all of 26. And everything that cuts into their margin, if they're dipping into cash just to pay for those products because of the elevated tariffs, that's going to put a squeeze on a lot.
Ahead of 2026, what kind of front loading are you seeing right now?
Cargo is moderate. It's not falling off a cliff. It's not saying the consumer is going to stop. We've got Lunar New Year on the 17th of February, so we'll see a little bit of a bump before then, and then an early springtime for fashion here, especially in the U.S. But also for the month of December, we're anticipating about 800,000 container units. That's a really good number, but it's off just a bit compared to the comps of an elevated 2024.
You started by saying that the total volume of shipments from China has dropped from 60% back in 2018 to now 40%. At the same time, yesterday we read a story saying that China just crossed the $1 trillion surplus mark when it comes to total exports. How much is the United States getting cut out of the global supply chains right now?
Now, two pieces here. Even though imports from China are down, exports from China to the rest of the world are up by double-digit fashion. They're finding other customers in Europe, Africa, and Asia countries. Second, because our exports have been really waning this year due to those tariffs and different countries stepping in, like Argentina and Brazil on soybeans, Australia with almonds, we're seeing a really depressed export market. And we only consume about a third of the ag products that we harvest in the United States. Balance 2/3 go to renewable energy and overseas markets. That's not there.
Do you feel like people are pretty optimistic when you talk to them that there is going to be some sort of calibration of some of these policies? Or do you feel like there is a sort of a gut check and sea change in the mentality of the businesses that you work with that have traditionally imported a lot?
The want is to get to a more stabilized environment. The actual on-the-ground work is still simulation. If I have to take another 10 percentage points of my sourcing from Vietnam, what does that mean? Do I have the services? Can I get the product to my regional DC in time for sales items, fulfillment centers, et cetera? So it's still a lot of extra work beyond the day-to-day execution of the supply chain.
Gene Seroka, wonderful to see you. Thank you so much for being with us here in New York. Port of LA Executive Director Gene Seroka here. And talking about small businesses, we actually got the small business survey from NFIB earlier this morning, and it came out at 99 from the expected 98.3. So actually inflecting a little higher, although far below where it had been. A real question here, though, about the disproportionate influence, whether it's a big company that has more resilience or whether it's a small company that's having to eat a lot of the prices.
If you're a Walmart, you're a Target, you're able to stockpile and you're able to really front load a lot of this, and you have a lot more flexibility. Also, great point by Gene, the de minimis tax. That is huge because you didn't have to pay a tax on any of these little trinkets that were under a certain amount, $800. Now you are paying that level of tariff and tax. And for a lot of these small businesses, the price and the cost of doing business has just gone up.
Yeah, which is the reason why you're getting investor days from a lot of different companies, potentially even the first investor day in years. And the clarity you're getting is not much because they don't have much clarity either. So the range of estimates is incredibly wide. We're going to continue with that conversation, especially as it becomes a very heavy deals environment. Coming up next, Sarah Hunt of Alpine, Saxon Woods, Eswar Prasad of Cornell University, and Sam Zief of JPMorgan Private Bank as we count ahead to that Fed meeting, that rate decision largely expected to end in a rate decrease. This is Bloomberg Surveillance.
Markets are looking sort of short term, right? They think that there's going to be another Fed rate cut.
There's a question of how much is appropriate to cut.
I probably wouldn't cut at this meeting this week because inflation is a concern for me.
The Fed rate cut is the right thing, and I think we'll get it.
There's so much at stake going forward with the Fed.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. Stocks range-bound as traders curb their enthusiasm about Fed rate cuts, with U.S. yields rising to the highest levels in almost 3 months. Hollywood drama meets boardroom drama with Paramount's hostile takeover bid for Warner Brothers, setting the stage for a new chapter in the media landscape. And NVIDIA getting a win as President Trump signs off on the sales of H200 chips to China. A real question about what this entails with a 25% tariff, as well as potentially a real question about the new landscape for national security.
New landscape for national security because this was seen as a chip that potentially was too advanced to go to China. But when China was given the offer to have the H20 chip, they told their firms, please shrug them off. We only want the best of the best. And actually, we also want to support our national champions. The most important question, I think, as you rightfully pointed out earlier, maybe this is why NVIDIA's stock is not rising as much, is whether or not China is even going to buy these chips. And the Financial Times has reporting this morning about Chinese regulators discussing ways to limit the permits, so buyers will need to go through a lengthy approval process. No final decision has been made, but it seems like China is going to be incredibly choosy on what chips they allow into which firms.
Yeah, which is the reason why I think people are not bidding up the shares even more of the likes of NVIDIA and AMD. Meanwhile, when we talk about the boardroom drama, some of the details coming out about the financing behind the Paramount bid for Warner Brothers, as well as Netflix's bid. Netflix's bid is really interesting. It features a $59 billion line of credit from Wells Fargo, BNP, and HSBC. For Paramount, their bid features money from the Ellison family, from Qatar, from Saudi Arabia, from Abu Dhabi, and of course, Jared Kushner, the son-in-law of President Trump.
And actually, this is the second time this year that we see the PIF, the Saudi Sovereign Wealth Fund, partner with Affinity Partners, Jared Kushner's firm, when it comes to doing a massive deal. This is why this is incredibly so interesting. It's not just who has the better deal for shareholders, it's what kind of makeup is the company. They're different, selling different parts or going after different parts when you look at these two deals. Some want Warner, Netflix wants the catalog and the studio. Paramount wants the whole thing, including the news division. Which one actually can get regulatory approval, I think, is really important. The president was asked about this yesterday. He said, I have to see what percentage of market they have. None of them are particularly great friends of mine, which I feel like Larry Ellison and Jared Kushner would disagree.
Well, either way, it does highlight how we are seeing a new era for deals and deal making, both in public and private markets. A real question of how much the Fed is going to continue to fuel this with not only a rate cut tomorrow, but also signaling potentially a slew of additional rate cuts early next year. What we are seeing right now in markets is a lack of real direction, trying to rebound just a touch, with the S&P up about 0.1%. You do see yields essentially flat at 4.16 on the 10-year. The sell-off in long end yields across the world has been notable and has really tempered some of that risk appetite and really somnolent when it comes to the currency markets, that dollar weakness that really has hit pause, as well as crude, which really has been hovering around this. Crude's been sort of a boring place right now because ultimately it's a supply-demand story that has more to do with OPEC than it does the consumer. Coming up this hour, don't miss this, Sarah Hunt of Alpine, Saxon Woods, as AI continues leading markets higher. Eswar Prasad of the Brookings Institute as the White House shifts its stance on selling NVIDIA chips to China. And Sam Zief of JPMorgan Private Bank saying rate cut bets may be too aggressive. We begin this hour with stocks holding steady. Sarah Hunt of Alpine, Saxon Woods sees AI as a major market driver, writing, we expect this to continue as we look forward to 2026 and also expect some volatility around the ever-moving sentiment on who wins and loses in the AI sandbox. Sarah joins us now for more. Sarah, good morning.
Good morning.
So let's start with the moving sandbox, that is, who is allowed to sell what to who. And this idea of NVIDIA potentially being able to sell H200 chips to China. Is that a game changer for you, given the fact that it rearranges some of our notion of what national security means?
I think there's been so much back and forth on this, and my recollection is that the H200 chip was one that was actually developed specifically to be exported, as opposed to some of the other chips that were not supposed to be exported. So I think that there's been a hugely moving amount of sentiment. I think that there is an argument to be made on both sides, one for security and one also for you want the paradigm to be the technology that we are exporting, as opposed to letting people develop technology, especially after the DeepSeek scare and some of the other things that have gone on in the AI world. I can understand why that makes some sense. But there's arguments on both sides, and at the moment, we'll see how much traction that gets when that's allowed.
It's come at a time of great competition. And I think that this is really important to the broader AI story. There are competitors, which is why it might be dangerous not to have a competitive edge and get people addicted to your chip. How much are we seeing a game-changing landscape when it comes into 2026 with Eddie Ardeni saying every company is a tech company? Those are going to be the big winners, not necessarily the rank and file that have benefited the most year to date.
Excuse me. Well, I think that that's part of the whole switch that people are looking for, which is we've been building out the infrastructure. We knew the companies that were making the infrastructure. Now we're looking for use cases. What are those use cases? Who's going to benefit the most by them? Who's going to end up having this be margin accretive as opposed to margin detrimental? And I think that that's where he's not wrong to say everybody's a tech company, because everyone's looking at how to incorporate this into their process and what to use it for, how to make things better, at the same time trying to trip over themselves and say, but we're not going to fire everybody, because that's also a concern on the labor side.
So who's doing it right now? Who's getting ahead of this and actually implementing AI in a way that you think it's worth buying some of those companies or some industries?
Well, I think that there's some enormous potential in places like healthcare. There are some companies that are specifically looking to take some of those wide-ranging numbers of candidates and narrow them down before you get into the lab, so that you have a much better shot on goal for some of the areas where people are looking for research on the biotech side. I think you're finally starting to see the biotech index pick its head up a little bit after it's been, the healthcare side hasn't been doing as well as some of the other areas. I think that's a place where the data and consolidating some of that data can be very, very helpful. But there are plenty of other places for that too. Like if you think about things like insurance and all sorts of things that use big, huge data sets, how can I use that information to sort of narrow down what might be the best outcome in a lot of different things? And I think that there are ways to do that. I mean, for us as well, you can get a lot of transcripts read, you can get a lot of things done and put it through. You don't necessarily have to believe everything it spits out, but it definitely gives you places to start that it took you hours to get to before.
How much do you need to see that story develop in 2026, potentially to quell any concerns, or the market to quell any concerns about an AI bubble?
I think it's a big deal to have that happen in 2026. Those use cases become more and more important, because you can talk about the ubiquity and how we're going to use things, but the spend has been enormous, and to some degree, some of these companies don't have the revenue to back up that spend. Some of the companies are using their balance sheets. Some of them are going to be taking out debt. This is going to be a big switch. It's a paradigm shift between companies that were all cash generative to companies that are now using that cash, companies that were asset light to all of a sudden having assets. I mean, you can make that argument with Netflix and Warner Brothers as well, right? That was not an asset firm. So I think that there is a lot going on into next year, which is why I think we're positive, but I think there may be some volatility. So there are some places where you want to be a little bit careful.
It sounds like you agree with the Goldman Sachs client survey that came out on some level, where they started talking about optimism, particularly in the light of some Fed rate cuts, accommodation from both fiscal and monetary policymakers, but also highlighting high valuations in the AI trade. So even though they are optimistic, seeing a year-end target of 7,000 to 7,500, not necessarily the 8,100 of John Stoltzfus. Do you kind of line up with that, the idea of modest gains that are choppy through the year with a slight churn when it comes to leadership?
I think we've had such a change since the financial crisis, and we always look to history and we say, well, there's going to be a mean reversion, or you can't have this many things happen. These things don't follow these things. I think that it's right now, the companies that are continuing to increase their revenues, regardless of their valuations, people are willing to pay for still, because they see a real path for that. I think that as you start to see things round out, that's going to help on the earnings front. If you start to see any kind of degradation in earnings, I would be much less optimistic. And I think that part of what people are building on for next year is some of the things that you mentioned on the fiscal front, but also in general, they're looking at an economy that they think is going to be doing fairly well. And if there's any change in that, or if you start to see earnings or margins have a problem, I think it's a much bigger issue than it would be at the moment that we see.
That's one side of the story, the idea that the stock market is seeing growth and optimism. The bond market is seeing enough weakness for the Fed to be aggressively cutting. And it seems like there is a sense of something has to give here. These two markets are not trading in tandem. Right now, we're seeing the bond market lose a little bit of footing with long end yields rising. Do you think that they're sussing out the strength in stocks, or do you think that this is something else that has to do with global phenomena that are really lifting yields?
I think the trickiest thing for central banks is that the global indebtedness has expanded so much versus where it was pre-financial crisis, that when bond yields start to move around, it becomes much trickier to figure out why are they moving in the direction that they're moving. And we've seen the decoupling of yields and stocks on more than one occasion over the last several years. So a lot of those relationships, historic relationships, are not holding because of a lot of factors that we can't quite figure out how to take into account. So it's hard to answer that. I think the concern is indebtedness. The concern is everyone's got to refinance a lot on the government side, forget the private side. And I think some of that is making it trickier to figure out exactly from a directional standpoint which way yields are, what the yields are telling us, I guess.
Also, is it part of it what's going on in places like Japan?
Absolutely. Because there is something that for years you had a fairly quiet, fairly consistent carry trade that everybody was looking at and everybody was sort of using. And then all of a sudden you see the yields in Japan go from a very consistent, almost zero, to not so, to much higher. And that has been a change. And I think under the surface, there's been a lot of money flow that accompanies that. But that's also one of those things that it's one of the many variables. It's hard to look at that specifically and say this happened because that happened. But it definitely is part of the concern about whether go with yields, right?
What's your highest conviction trade heading into 2026?
We think that there is going to be a catch up on small cap. We think that some of the areas that have not benefited as well, you had 2 years of you had 2 years of bad earnings in small cap, and everybody kept saying this is going to be their year, this is going to be their year. I think some of that, you're lapping such bad performance that you can see an earnings jump, and people like to see those earnings jumps. You have to be profitable. We look at companies where we want to see the cash flow, we want to see the ability to either buy back your own stock, which in small cap is harder, but if you start to see dividends getting paid, if you start to see that expansion of cash flow, we are very balance sheet sensitive right now. We run a dividend product and a capital return product. We're very balance sheet sensitive because there's a lot going on with cash.
Small caps that we've seen actually really gain favor over the past couple of weeks. Sarah Hunt of Alpine Saxon Woods will be sticking with us. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Anand. Yahaira.
Hi, Lisa. Google is being investigated by the European Union over whether it has abused its dominance by using its own AI tools to squeeze out competition. The commission saying it will look at whether the firm has distorted competition by imposing unfair terms on content creators and giving its own AI model an advantage over its rivals. Meanwhile, 2 men are being detained by the DOJ for allegedly attempting to smuggle at least $160 million worth of NVIDIA AI chips to China. The department alleges the men operated a network that replaced NVIDIA labels from H100 and H200 AI chips with the fictional Sankan brand before shipping them. A third suspect has already pleaded guilty. And Jimmy Kimmel is back for at least one more year under a new deal with ABC. Sources telling us here at Bloomberg that Jimmy Kimmel Live will continue until at least May 2027. We're told the host and Disney agreed on an extension months ago, but delayed announcing their plans out of respect for axed fellow late-night host Stephen Colbert. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. Up next, Paramount versus Netflix.
I know the companies very well. I know what they're doing. We have to see the Netflix percentage of market, Paramount, the percentage of market. I mean, none of them are particularly great friends of mine.
Even his son-in-law? We'll talk about that. Bloomberg's Tyler Kendall joins us next. This is Bloomberg Surveillance. Trying to get that Santa Claus rally underway. Yesterday, we snapped it. We snapped that positive mood. 4 days of winning streak that did come to an end today. Just a little tepid lift to futures as the session grows older. Meanwhile, in the yield space, watch this because this has been really driving a lot of the risk sentiment. Yields up yet again in the 10-year, 4.17% when you round it up as you see yields climb to some of the highest levels that we've seen since the end of September. A real question about the state of the economy, given that we are operating somewhat in a fog. Today, we do get the JOLTS job openings data, as well as the quits rate. That, to me, is going to be very key. Tomorrow, we get ECI, the employment component index, the employment cost index, as well as, of course, that Fed rate decision, and Jerome Powell coming out with his statement with some sort of forecasts. Jobless claims on Thursday. Before that, Oracle. A real question here about whether people are getting an accurate read right now in the economy.
It's going to be a huge question because, as Andrew Hollenhorst just published, preparing for a few months of weird data, we're not even going to get October, November PPI data until January of a new year, which is why today and tomorrow's Fed meeting is so important. Likely they're going to cut, but what do they signal for 2026, given the fact that the data is just frankly weird given the government shutdown?
Yeah, how do they see the inflationary pressures versus some of the job losses that we have seen? Meanwhile, in the deal space, all eyes on the boardroom drama under surveillance this morning, Paramount versus Netflix.
I know the companies very well. I know what they're doing, but I have to see what percentage of market they have. We have to see the Netflix percentage of market, Paramount, the percentage of market. I mean, none of them are particularly great friends of mine. You know, I want to do what's right.
Here's the latest. Paramount Skydance launching a hostile takeover bid for Warner Brothers at $30 a share in cash, valuing the company at more than $108 billion. That offer coming just days after Warner Brothers agreed to a deal with Netflix. Bloomberg's Tyler Kendall joins us now for more. Tyler, how much does the White House really hold the keys to who wins this deal?
Yeah, hey, Lisa. Well, each deal's potential to pass regulatory clearance here in Washington and with the Trump administration is going to be a big factor, as President Trump himself has said that he will be directly involved in any decision. But as you just heard, the president also maintained yesterday that he's not close with either company, Netflix or Paramount. This despite, of course, Paramount's bid being championed by the Ellison family, which, of course, has close ties to this White House and includes equity backers like the president's son-in-law, Jared Kushner's private equity firm. The president did maintain yesterday that he has not spoken to Kushner about the proposal. Now, Paramount's bid is notable not just, of course, for the proximity of the players to the White House, but also just the scope that we're talking about here. It includes sovereign wealth funds from Saudi Arabia and Qatar. Now, our reporting indicates Paramount has really been lobbying officials here in Washington. There was reporting that the CEO, David Ellison, did meet face-to-face with President Trump at the Kennedy Center honors over the weekend as they try to pitch investors that they have the clearer path when it comes to passing regulatory muster. And they're arguing, of course, that Netflix would harm competition when they're talking to officials. But Lisa, we can't forget that it was a Bloomberg News scoop that Netflix CEO Ted Sarandos met with President Trump in recent weeks at the White House, where he made the case that Netflix competition isn't only in the streaming space. I will point out that at that time, people familiar tell us that Sarandos left that meeting with the feeling that he wouldn't face immediate opposition from the White House.
Tyler, one of these bids includes the news division. One of them doesn't. I'm wondering whether the news division, potentially a tie-up between Warner Brothers, ABC, and CBS, the question of David Ellison winning this versus Netflix, whether that could potentially be a problem for the president, given some of his pushback on the media landscape.
Right, exactly. And you heard, Lisa, in that move, in that clip that you played, President Trump talking about how the media has been portraying this, often saying that he himself is going to take a look at the players and at the factors here. But particularly when we're seeing this reporting around what could happen to the future of CNN and how Paramount could address that, since we know that it's a top concern for President Trump, that really might play into the picture here. But at the end of the day, we have to keep in mind that, of course, whatever happens here, there's going to be that regulatory scrutiny. Typically, we are expecting that this is going to fall to the Department of Justice. They're the ones that typically oversee media mergers, and that could take anywhere from 10 months for an investigation to wrap and then ultimately decide whether or not to sue to block a deal. So there is so many factors here that we have to weigh, and it's going to take a while to shake out.
Tyler Kendall of Bloomberg, thank you so much for that. Sarah Hunt of Alpine Saxon Woods is still with us. Sarah, I am curious about the backdrop for this. Debt markets wide open, happy to finance it. Banks willing to put up a $59 billion bridge loan, one of the biggest ever, as Netflix does go forward in this deal. Does the mood of markets seem to be shifting to a very different kind of LBO-esque 2006, 2007 kind of feel versus where they were to start 2025?
I think there's definitely been a pickup in mergers and acquisitions, and I think that to some extent the fact that the IPO market has been so quiet is one of the things that's got everybody jumping on M&A as opposed to some of the other aspects of capital markets on the equity side. So I think there's definitely, between the fact that there is plenty of money looking for a home and plenty of people looking for transactions, I think that you've definitely seen a step up in the last several months.
What does it say that this is not a one-off, that this is now becoming a fight when it comes specifically about the assets for Warner Brothers?
Well, I think, you've had an industry that has been so disintermediated by the internet, and you have, even thinking about the news division, right? How many news channels did there become over a period of time? How much of an audience does everybody have anymore? It's not the way we were. We still think of it, certainly those of us of a certain age, of a major three networks and everything else. It's been a very different situation. And between that and what has happened with streaming and taking things out of the theater, I think there's a lot of different issues to play with on the regulatory front. And it's going to be tough to make all those decisions. But I think that you have some real issues potentially with both of these.
What does it say about Netflix shareholders, given given where the stock price is. It doesn't seem that they like this idea and this idea of bringing on more assets. To your point earlier, that these were companies in the tech space that were cash heavy, asset light.
I think that is one of the head scratchers about the change in strategy from an outside perspective, looking in and saying, look, you've got this fantastic streaming service. If you're Netflix, you've got an enormous amount. You're generating an enormous amount of cash, which for several years they weren't, right? So they were penalized when they weren't generating cash, and they were paying all this money for content because people were trying to figure out how that was going to work. Well, they've got that to work very well, and now all of a sudden this is a change again, and I'm not sure how people are going to feel about that. I think that's one of the things that we have as a concern for next year, which is the returns on the cash that most of these companies have been getting for a long time has been fantastic. They're now putting it in a bunch of assets that may not have the same return profile. That is a paradigm shift that the market is going to have to come to grips with, especially given the valuations.
Would you rather invest on the debt side or on the equity side, given the fact that there is this change?
It's an interesting question. I mean, we're mostly equity people. We do some fixed income work, but we're mostly equity people. I think that depending on how levered you are, yes, I'd want to be looking at the debt versus the equity. But I think that right now, I mean, what this would do to Netflix isn't driving it into crazy levered territory. And it looks like what they're trying to do with Paramount Skydance is raise more equity than debt, because that's already an indebted situation. So it depends a little bit on what the entire capital structure looks like and what you think the cash flows are going to be after that. You know, there are arguments for both, but it sort of depends on what you're looking for.
Apollo's Jim Zelter was on earlier, just the past couple of weeks, and he said people are expecting disruption in business models, but aren't pricing in how exponential some of the revaluations can be, that things can go to zero, right? I'm thinking of Xerox, I'm thinking of Kodak, I'm thinking of other companies that just overnight become obsolete. You see, for example, a real question, existential question around some of the movie theater operators, right, in the wake of a potential shifting in business model. How do you avoid those potholes of potential businesses that suddenly overnight just become worth nothing?
Well, I think that this is one of the reasons that we like to follow things like cash flow as opposed to just earnings, because you start to see companies not be able to generate cash as things start to get worse. They may be putting up earnings for a variety of different reasons, but you want to look at that and make sure that you really are still seeing a business model that is viable regardless of what is going on. I think this goes to the networks again. This is one of those issues where you had these big cash generative networks, and then all of a sudden they paid up these massive amounts of money for sports and everything else. And then you're wondering, like, is the advertising really coming in strongly enough to support all of that? And I'm not sure the answer to that is yes. And I think that if you follow that trajectory, that gives you some insight into what's going on in the future.
Sarah Hunt, thank you so much for being with us. Sarah Hunt of Alpine, Saxon Woods. So you don't believe, Annmarie, that this actually is someone, President Trump, who has not talked to his son-in-law or potentially even one of his best friends?
Well, he's talking to everyone involved. And your question to Tyler about what it means for the news division, Wall Street Journal overnight had this story about how there was a December meeting. David Ellison offered assurances to Trump about changes at CNN. This is according to the Wall Street Journal reporting. And it said Trump has told people close to him that he wants new ownership of CNN as well as changes to CNN programming. That can also cast a cloud of a ton of controversy around this deal if Paramount ends up winning over in the bidding war.
This deal is going to be full of controversy. Also, the idea of U.S. banks versus Middle East money, a whole host of other questions that we'll continue to be asking. Coming up next, we'll be talking about NVIDIA. Eswar Prasad of the Brookings Institute as the White House reverses its stance on selling NVIDIA chips to China. Plus, Danny Berger with your morning movers. AutoZone shares falling as first quarter comp sales missed estimates. From New York, this is Bloomberg Surveillance. The big question for today is, can bond markets sustain some sort of rally after 2 straight days of losses, with yields rising to the highest levels going back to September? Take a look at the stock market. You are seeing really range bound, hovering between gains and losses, with the S&P futures up about 0.1%. It really does hinge on 2s, 10s, and 30s, whether we do see any kind of bid. Earlier this morning, we did see a bid into the long end. We continue to see that just marginally after that 2-day sell-off that really did and send yields much higher. Two-year yields getting a little bit higher as well as people pull back some of the expectations. This is heading into that two-day meeting with the Federal Reserve where they're widely expected to cut rates. Key question, how much can they possibly cut next year, given the fact that everyone's expecting a rebound in the U.S. consumer? 2 hours away from the cash open, here are your morning movers with Danny Berger. Danny.
Hey, Lisa, earlier this morning, we got an update from CVS at their Investor Day, and it is one where their earnings outlook that beat expectations. Their revenue didn't, but I guess the earnings was enough to lift things higher. They also gave outlooks through 2028. Their plan, Vital Knowledge analysts say that it does imply that their expectations are ahead of the streets. They also talked about a new consumer platform that was, of course, AI-enabled. Shares up just under 3% this morning. Elsewhere, I talked about this yesterday, CoreWeave issuing more debt in the form of convertible bonds. It was $2 billion. Their shares fell 2.3% after that news. This morning, they announced that they're actually upping the size. It's going to be $2.25 billion. So it's the same reaction as yesterday. Shares fall this morning by 1.6% in the pre-market. Finally, we got some earnings from AutoZone just moments ago. Those earnings also missing expectations. It's again this concern about the consumer, big ticket purchases. So what does that mean for different parts and supplies for their cars? The CEO also talked about the fact they're going to aggressively open stores. They're hoping to capture more of the market share. Those shares down about 1.7%, Lisa.
Thank you so much, Danny. Just picking up on what you talked about, Danny, with CoreWeave. Really interesting to see CoreWeave continuing that slide. This convertible share sale is really highlighting how much convertible bond sale is highlighting how much they need to raise money to finance some of what they're doing for OpenAI. Again, this all comes back to Sam Altman and his shadow over this market.
Well, this is why people are concerned about an AI bubble, because the circular transactions between these companies, it's why you have basically the plug of an outlet into an outlet bank. It is just absolutely circular. And until they start showing more profit and showing that actually how AI is working, not just the basics of what we have now with ChatGPT, but across sectors, this is going to be a huge story for 2026.
A real question here about dilution. The financing further strengthens CoreWeave's balance sheet while lowering its cost of capital as the company scales its AI cloud platform to meet unprecedented demand. We'll pick up on that in a bit. On our radar this morning, Paramount launching a hostile takeover bid for Warner Brothers Discovery. The bid is being supported by a more than $40 billion equity commitment from investors, including Saudi Arabia's Public Investment Fund and Jared Kushner's affinity partners. Watch this space in terms of which poses a bigger conflict of interest, potentially a bridge loan from some of the banks or potentially a cohort that includes President Trump's son-in-law and some of the Middle Eastern allies.
This is going to be incredibly complicated. Warner Brothers has 10 days, December 22nd, they have to give, there's the final date to Paramount, and then Netflix will have 4 days. So this could drag on. It's definitely going to drag on into 2026. But the biggest question right now is not just who has a better deal and for what assets, it's who can actually get regulatory approval. For Netflix, a huge question is going to be about market share when it comes to streaming. And then for Paramount, I think a big question is going to be about all these characters are involved. You have 3 sovereign wealth funds out of the United States, also Affinity Partners, which is the private equity firm of the President of the United States' son-in-law.
Meanwhile, in the other geopolitical news, President Trump threatening an additional 5% tariff on Mexico over a water dispute. The president also warning of new levies on Canadian fertilizer and Indian rice. The move's coming as the Supreme Court considers the legality of the president's sweeping global tariffs, and President Trump saying in a recent political interview that he's interested in possibly lowering tariffs in order for cost of living concerns. We will get into that as well. President Trump, meanwhile, granting NVIDIA permission to sell its H200 chips to China in exchange for a 25% surcharge. The decision allowing NVIDIA to potentially regain business from a key global market and is considered to a win in its efforts to curb export control. Bloomberg's Mandeep Singh joins us now for more. Mandeep, how unexpected was this, given the fact that NVIDIA wrote off any sales to China in its latest earnings release?
I mean, look, I think we have been going back and forth in terms of NVIDIA's ability to sell to Chinese customers. And in this case, I think this is a newer sort of variation of that H20 that they were allowed to sell in the region in the past. And it's not the latest Blackwell chip. So from that perspective, clearly, they are still managing to sell an older version of the chip. But the Chinese market, as Jensen has highlighted, is huge. I mean, he himself has said it's a $50 billion opportunity. And just to put it in context, we're like the hyperscalers will make up almost 160 billion in revenue for NVIDIA next year, when they will be over a $300 billion base. So there are three big hyperscalers in the China's region. And so if they're able to sell up to $50 billion, that will be huge in terms of what it means for NVIDIA's top line growth. And that's why they are keen to, sell anything they can when it comes to the China market.
When it comes to the share price this morning, though, isn't it reacting to the fact that they don't think they're going to be able to sell that much? And the Financial Times this morning talking about buyers are going to need to go through a lengthy approval process, showing why they can't use homegrown champion chips and they have to use NVIDIA.
Yeah, look, and that's where the back and forth that has been there in the past when they were able to sell H20s and then they had to completely, take it out of their guide. There is that, security aspect that continues to come into play in terms of what are the Chinese LLMs currently using? What are they training their models on? And so it's not a done deal. But from an NVIDIA perspective, I mean, there is no doubt that it will be a positive if they are able to sell to the Chinese market, because they have to find big hyperscalers as new customers. They already have all the ones outside of China. The question is, that's where all the LLM companies are in China, and they want to be able to sell to them. So it will be interesting to see if they're able to follow through and, sell in scale, which is what they want to do.
Mandeep Singh of Bloomberg, thank you so much for being with us. Turning to the trade war between the U.S. and China, China's top leaders signaling they are on alert for a potential flare-up as they draw up economic plans for next year. Joining us now to discuss, Eswar Prasad, Senior Fellow at the Brookings Institute. Eswar, thank you so much for being with us. I want to start with the trade war in the context of this recent move by the United States for NVIDIA to be allowed to sell its H200 chips into China. Do we have a sense of where buying those chips fits into China's plans as they try to turn more inward and rely on domestic champions?
So we are looking at competition in one area which is going to be the most intense between the US and China, which is technology. The Chinese government has been very keen on upgrading its manufacturing sector, moving up the value-added chain and trying to dominate the high technology sectors, solar panels, electric vehicles, and now AI. For the US, it's a very dicey strategy right now. On the one hand, you don't want to lose access to the Chinese market or deny China some of these chips, because that means that it gives China much more of an incentive to move forward with its domestic innovation strategy. But at the same time, providing these chips to China does make it a lot easier for them to move forward in terms of that innovation. And of course, the Trump team seems to be betting that this is going to help NVIDIA gain significant market share there. Whether that's going to be a durable increase in market share, whether NVIDIA can hold on when China competes with all the state resources behind it, I think is a key question. But in the short term, NVIDIA's revenues are certainly going to take a big positive bounce. And there are going to be some revenues coming in for the U.S. government, but I'm not quite sure that this is going to serve the long-term U.S. national security or economic interests very well.
Eswar, I'm wondering, the Belt and Road, the digital Belt and Road that we've heard Jensen Huang talk about, that China would create a system of dependence on some of its technologies and goods in Southeast Asia. How far has China gotten in creating that type of ecosystem where domestic economies nearby really rely on China, both technologically as well as beyond that?
So in terms of trade and finance, China has certainly made a lot of progress through the Belt and Road and other initiatives. And technology is what they're coming from. At the moment, I think there is still a sense that China is able to not innovate fundamentally, but take existing innovations, many of which come out of the US, and commercialize them and scale them up in a way that is, clearly world-beating. And that is the advantage that is certainly very relevant in terms of increasing the scope of its technological, influence within Asia. And that is happening. It is happening a little slowly. And the fact that the U.S. is somewhat receding from the region, and many countries in the region feel that they cannot disengage from China because they don't have an alternative, trustworthy partner, is certainly helping China in this process.
Eswar, when it comes to China, its relationship with Europe, especially now, given Emmanuel Macron was just there, he's talking about how it's unstable. Do you see China going to have to not just dump more in Europe, but have to invest more in Europe because the walls have gone up and it's been so complicated with the United States?
The walls are going up for Chinese exports, and they're going to go up more because the reality is that China has now a very, very unbalanced growth model, with most of the growth coming from the supply side of the economy, which in normal times is not a bad thing, but domestic demand is not keeping up. And with every passing day, every passing quarter, there is more capacity in China that needs to be exported. The U.S. has put up walls, at least to direct Chinese exports to the U.S. So Europe and other countries that need exports themselves to bolster their economies are going to face the brunt. And China is very cognizant of this issue. Its reliance on exports to power its own growth, but also the fact that walls are going up to its exports around the world. So it is trying to befriend these countries by essentially investing in those countries. And this again poses an existential risk, in my view, for some of the companies in these countries, especially in the high technology sectors, because they could get swallowed up by these Chinese investments and essentially find it very difficult to compete against Chinese firms operating on their own soil. But that's the direction the Chinese are taking. And at the moment, very few countries are able to resist.
A lot of times the United States will say that they are pushing other countries to do this, to not exactly combat, but have this competition with China. But what kind of message is the U.S. sending at the same time when they're basically showing that they want to put trade and economic concerns higher than national security concerns, with President Trump allowing NVIDIA to sell the H200 into Beijing?
Yes, some of the policymakers I've spoken to, you do point to what they see as U.S. hypocrisy in the sense of trying to put up barriers to Chinese imports, trying to limit exports and trying to get them, that is, other countries to do the same, while at the same time the U.S. seems very, very willing to trade off many issues that the U.S. claims should be very important, including national security considerations, for short-term economic gain. And this NVIDIA decision is a prime example of that. So certainly the message that the rest of the world is hearing from the U.S. is one of great inconsistency and some degree of short-termism, rather than really viewing the long-term economic and national security of the interests as being the prime drivers of U.S. policy.
Eswar, over the past couple of years, you and I have talked about a real question of how much the U.S. will lose some of its dominance globally as a result of some of these shifts and concerns that you talk about. We haven't really seen it. You have seen some sell-offs arbitrarily in the dollar, sort of momentarily, not arbitrarily, and a real bid up in the price of gold. But have you seen a sustained shift away from the U.S. financial system by some of the trade partners of the euro?
In short, no. I think the reality is that the U.S. remains a dominant economy and dominant financial market in the world. In terms of final consumption demand, it's still the most important. And relatively speaking, in terms of its financial market depth, size, and its institutional framework, which is certainly being eroded as we speak. But overall, this package is going to be very difficult for any country to beat. And despite all the concerns about U.S. government debt, about the U.S. institutional framework, including the central bank independence and so on, what we have seen is foreign investors have continued to buy significant amounts of U.S. treasuries and other U.S. financial assets, and this includes foreign central banks. Certainly, foreign central banks and everybody around the world is trying to diversify away from the dollar. They're doing so at the margin, but really there isn't much of an alternative to the U.S., and we see that in investor behavior very clearly.
Eswar Prasad of the Brookings Institution, thank you so much for being with us this morning. Wonderful insight. Just as Eswar is talking, JPMorgan puts this outlook out where, as they say, they expect emerging market equities to outperform developed market in 2026. So maybe not shifting away from the U.S., but bright spots elsewhere as well.
Especially when you look at places in Asia, especially China, when it comes to the fact that just this week they basically had a former NVIDIA executive launch an AI company. They are putting everything they can into these homegrown champions.
Yeah, talking about how a second year of outperformance from emerging markets comes after years and years of underperformance. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. We're seeing CVS shares rising 3% in the pre-market. The healthcare company raised its full-year profit forecast and said earnings would rise in 2026. It's a sign of hope as it navigates a turbulent retail environment. plus government scrutiny across the healthcare industry from vaccines to insurance. Meanwhile, Michael Burry says he holds sizable positions in Fannie Mae and Freddie Mac common stock and believes a relisting is, quote, nearly upon us. Burry became bullish on the companies after President Trump's election and says regulators must ease capital requirements and scale back the government's claim on the companies for an IPO to occur. And the Los Angeles Chargers continued their push for the playoffs after defeating the Philadelphia Eagles to wrap up Week 14 of the NFL season. Eagles quarterback Jalen Hurts struggled, committing 5 turnovers, including a game-ending interception, as the Eagles dropped their 3rd straight game. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. Up next, preparing for the Fed's decision.
I wouldn't be surprised if we see 3 cuts, so starting probably this week with the first, and then 2 more into next year. The U.S. is a bit in a weaker spot.
Sam Zief of JPMorgan Private Bank joins next. This is Bloomberg Surveillance. Good morning. Right now, we're looking at markets, looking ahead to the Fed meeting and a question of just how much the Fed will signal they are going to cut next year. A bit of an optimistic tone in equity futures. Bonds just fluctuating here after a couple days of a sell-off that left yields at the highest levels going back to September. Under surveillance this morning, preparing for the Fed's decision.
I wouldn't be surprised if we see 3 cuts, so starting probably this week with the first, and then 2 more into next year if you look at a 12-month time horizon. I think that could be justified because although there is fiscal spending, yes, and increasing, but I would say at this point in time, the U.S. is a bit in a weaker spot. Inflation remains a topic, so we don't see inflation to substantially come down.
Here's the latest. Markets eyeing the Fed's dot plot as a divided central bank is expected to cut interest rates by a 1/4 point tomorrow. Sam Zief of JPMorgan Private Bank writing, markets may be too aggressive in pricing the number of cuts. We anticipate the Federal Reserve will continue lowering interest rates with a total of 50 basis point cuts by the end of 2026, which seems to be consensus right now. Sam joins us now. Thank you so much for being here. I wanted to start with what we've seen over the past couple of weeks in bond yields, particularly on the longer end. Why do you think there has been such a huge increase over the past couple of weeks?
Absolutely. I mean, it really does seem like it started after Halloween, after the Fed's meeting. So I think there's a 2-pronged thing that's happened here. Where one, the Fed did become a little bit more hawkish after its last meeting, signaling that the bar to further cuts is going to be higher. And we can talk about how that looks in 2026. And the other is that global sovereign bond yields are highly correlated. And we've seen sell-offs not only in Japan, but also in the UK around the budget. And so I think that's really been kind of infecting the long end of the U.S. bond market at the same time.
Is this bond vigilantes coming back and saying deficits are too high? Or is this an issue of true inflation that people see as being persistent and sticky around the world?
I think it's an acknowledgement that central banks are getting to the end of their cutting cycles. The Fed might be the last one to get there. But if you look at basically money market curves across most developed market economies outside maybe the U.S. and the U.K., they're all upward sloping now. All of these central banks have normalized rates. They're all near neutral. And the market is basically saying, look, there's no moves coming soon, but if there is going to be another move, because growth looks okay going into 2026, it's probably higher, not lower. And that's what we're seeing reflected in these curves.
It seems like markets have kind of come along with what you believe for next year. Have we fully priced in the scenario that we'll only cut by 50 basis points in 2026 based on the yield move that we've seen over the past couple of weeks?
I'd say that there's still a little bit more priced than we're expecting. I see the terminal rate priced at a little closer to 3%. We think that they really only get down to 3.25 to 3.5, not massive differences, but a bit. It's really about the labor market, right? The U.S. labor market is soft right now, relatively weak, you might even say. Our view is that as you move through 2026, it looks stable, resilient, even improves as it goes along, and that's what's going to determine the Fed cutting path. I think that's what we're going to hear from them this week, that, hey, they're going to cut this week. From here, it's going to take further weakness in the labor market to get them to move a lot more. And that's not something we expect. That's something that investors have to really make a big call on for 2026.
How do you think about all of this playing out to the fact that we are going to have a changing at the guard at the Federal Reserve, and Jay Powell's a lame duck, and everyone's just waiting for the next Trump nominee?
Yeah, I'd make 2 observations about it. One, and we have to remember this is a committee. So a new chair can come in and they could be hawkish or dovish, but in general, they've got to convince the entire committee how to move. And if you look at everyone across the committee, we can read all of their speeches. They're all pretty academic. They're all pretty much just interpreting the data. And I'd also make the observation that that seems to be how the market is interpreting this. There aren't huge changes in market pricing for before May and after May, when Powell's supposed to go. And there aren't huge changes. A terminal rate priced into the market around 3% is, I think, very consistent, maybe a little bit more dovish than our economic expectations, but very consistent with overall consensus economic expectations. If there was some huge pricing in the market about concerns about how the Fed outlook was going to evolve, you'd expect that to be much more dovish than anyone's kind of central economic scenario. And I would argue that's not the case. Really, it's all about the labor market and the growth outlook.
Why do you think then bond investors told Treasury they were concerned about a Kevin Hassett chairman?
Well, I'd look at betting market odds, and that's how we've done it, which basically we've looked on days where betting market odds have shifted in terms of who it's likely the next chair is going to be, and then looked at market reactions around those changing betting market odds. And we don't see a huge relationship between that in any direction. And so I would really argue that it's really about how the economic outlook evolves. And we can talk about all of these things all day long, but when we look at what's driving market pricing across the curve, across FX markets, across markets in general, we think it's the economic fundamentals.
If you think the Fed is not going to cut as much next year as people expect, do you expect dollar strengthening, not dollar weakening, as so many people seem to believe?
Yeah, we really don't. Maybe that's where we're out of consensus. We really don't see the dollar set up for the same type of year as it had in 2026. The real driver for the dollar's weakness in 2025 has been that economic convergence between the U.S. and the rest of the world. Growth convergence, interest rate convergence. And in 2026, as the labor market stabilizes, we just don't think you're going to get any more of that economic convergence, really. So unless the economy ends up much weaker than we expect, we think the dollar is at least stable, and that's how we're investing, around a stable dollar. And the risks are that if the economy accelerates more than we expect, you could absolutely get a stronger dollar.
Sam Zief, thank you so much for being here. Really appreciate it. Sam Zief of JPMorgan Private Bank. As the market does expect, yes, a 95% chance that the Fed will cut tomorrow. But heading into 2026, the likelihood that there will only be 2 rate cuts, that's down from 3 just a couple of weeks ago.
And potentially hearing from him, you just have to ignore all the noise coming out of Washington. It all comes down to economic conditions and the labor market, which is why actually next week's non-farm payrolls are going to be so important, because they're coming after the Fed meets, and we're going to get some real clear-cut data on what is going on in this labor market.
Yeah, nothing's really been too clear-cut. We did get some NFIB small business optimism that did come in just a touch higher earlier this morning. We do get job openings and the quits rate coming out at 10 a.m. Eastern. Coming up, we get Michelle Weaver of Morgan Stanley joining us here in studio, Bloomberg's Jennifer Rhee and Jonathan Pingle of UBS, as we look ahead to that Fed decision, as we look ahead to boardroom drama with the media space very much front and focused, and as we look forward to the AI trade, as so many people discuss the bubble word and whether we've overused it heading into 2026. This is Bloomberg Surveillance.
The direction of travel, things look great right now.
We're entering this phase of AI application.
AI is not a bubble. I think it's still a boom and a structural change. And that's why we are constructive for next year.
AI is certainly going to change the world. But who are going to be the winners in that?
You can look at either side of the coin on so much of the data that's out here, and you could either be bullish or bearish.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance, kicking off a Fed meeting with high expectations for rate cuts, with focus now turning to the state of the economy. Some jobs data on deck with jolts later this morning. Meanwhile, new details emerging in the boardroom battle between Netflix and Paramount as they wage war over the purchase of Warner Brothers Discovery, and a question about big tech as President Trump opens the door to high-tech chip sales to China. The national security concerns going from access to potentially losing out in the race.
And China has responded. Basically, according to the Financial Times, they're going to look piece by piece, deciding maybe which firms can get access to this chip. And does it even matter? Because China might shrug it off, even if they're allowed to buy these H200s like they did with the H20. But I think the signal is clear. The Trump administration is putting trade and economic concerns over national security concerns. which in this sector is definitely a pivot.
And right now, people are looking to the artificial intelligence melt up that really drove 2025 potentially changing in 2026. We saw that in the Goldman Sachs survey. We saw that from Ed Yardeni coming out and saying that he does see a potential underweighting of big tech as warranted, as everyone is a tech company. And that really is what we heard from Sarah Hunt earlier this morning and the outperformance that we've seen of late in the Russell 2000.
And she's talking about how all these tech companies had a lot of capital and now they have a lot of assets and they have a lot to show for when it comes. In 2026, what everyone continuously says to us, they want to see that broadening out in AI, not where the use cases are and which industries are actually adapting. And if they don't see the use cases and the adaptation of AI, then what is all this money for? Another key thing for 2026 is going to be the gap between the electricity need and energy needed for these data centers, and if this mismatch can that narrow.
And right now, people are looking at what the Federal Reserve's response is going to be to all of these dynamics. That meeting in Washington, D.C. kicking off. It will end tomorrow with a press conference with Jerome Powell. Meanwhile, in markets right now, really quiet, range-bound, ahead of that decision, ahead of a slew of deals that we talked about earlier with Warner Brothers being bid up by both Netflix and Paramount. Yields, watch this space. We saw a huge rise in 10-year yields over the past 2 weeks. Right now, near the highest levels going back to the end of September. Do we maintain that type of level after tomorrow's Fed meeting, given the fact that the market right now is still expecting at least 2 rate cuts next year? Coming up today, we have the jobs opening data, as well as, of course, the data tomorrow of the employment cost index ahead of that Fed meeting. Coming up this hour, Michelle Weaver of Morgan Stanley with stocks searching for gains, Jennifer Rhee of Bloomberg Intelligence on the possible antitrust concerns surrounding a deal for Warner Brothers, and Jonathan Pingle of UBS previewing the December FOMC meeting. We'll begin this hour with stocks flat ahead of the latest Fed decision. The team at Morgan Stanley expecting a cut tomorrow, followed by 2 more next year. Michelle Weaver of Morgan Stanley writing, this is a bullish setup for stocks that are looking ahead towards accelerating earnings revisions and Fed cuts based on lagging moderate labor market weakness. Michelle joins us now. Michelle, thank you so much for being with us.
Thank you.
It seems to all be predicated on the idea that 2 rate cuts comes with strong growth.
Yes.
What gives you confidence that we are going to get strong growth despite some of the weakening that we've seen in recent labor market metrics?
Yeah, so we think that we've seen in the alternative data more softness in the fall. So I think when we get the official numbers next week, we are going to see more softness, but that we're not going to get one of those non-linear, really concerning type rises in unemployment data. We think the setup is really constructive into next year for a broadening in earnings. If I think about the past couple of years, it's all been about the large cap stocks. It's all been about those who are exposed to the AI trade. We've seen a lot more weakness under the surface for the Russell 3000 over the past couple of years. Earnings growth has been flat to negative for most of those stocks. We finally saw that turnaround last quarter with those names growing 8%. So we are starting to see a more constructive setup for that broadening. And I think that combined with a Fed that is easing, but without a really concerning spike in unemployment, is a great setup for stocks into next year.
Is it as simple as saying that some of these smaller companies are deploying some of these AI tools to be more efficient and preserve some of their margins? And that's the reason why you might see an outperformance.
I think AI is certainly part of that story. When we think about AI deployment, next year I think is really going to be the year of the AI adopter. It's taken companies, a couple of years to work with the technology, to set up the guardrails, to retrain their employees, to really get AI deployed. Our tech team has a great CIO survey. They think that by the end of this year, 60% of companies will have at least one AI product live in the field. And then that will rise to 80% by the end of next year. So we are finally starting to see this wave of adoption flow through the market.
Can you see that wave of adoption without layoffs?
I think you can. I think around the margin, you may see some companies do a little bit of layoffs, but it's largely going to be an incremental story. I think a lot of the messaging I've heard from CEOs on earnings calls is we're going to keep headcount flat, but we're going to be able to see more growth. We're going to be able to do more with the same number of employees thanks to AI.
Do you think that AI can also continue if the energy demand isn't quite there? So are able to meet that demand?
Yeah, it's absolutely a tricky setup around the power world. Our team has a great model where we take our semiconductor analyst chip sales forecasts, say what's the power needed for that and how much power are we going to need in the US. Through 2028, we're forecasting a 47 gigawatt shortfall in power just through the traditional grid interconnect power. For scale, that's around 10x the power consumed by New York City, so that's a huge shortfall. But there are a lot of innovative type of solutions that can apply to this. So
we're 10 New York cities short.
Yes.
Wow.
But through things like natural gas turbines, those are behind the meter. Those are apart from the grid interconnect process. And then Bitcoin site conversions, I think, are really interesting. So some of these companies have essentially realized that the power that they're sitting on is more valuable than some of the underlying business. We think there's around 20 gigawatts there, so there's a lot of power to be had there. And then nuclear is the last one that's a little bit more politically challenging, but we may see some nuclear for that problem.
Bitcoin conversion sites. Are you saying that people who previously mined Bitcoin aren't necessarily seeing the gains there, and so they're transforming that into a fuel essentially for artificial intelligence? Is this the sort of not the death of the Bitcoin trade, but really the shifting in terms of where the enthusiasms go that has broader market implications?
Yeah, so I wouldn't say it's the death of the Bitcoin trade by any means, but there were some Bitcoin miners who'd amassed a ton of energy to be able to do Bitcoin mining. And they essentially saw, we're sitting on a gold rush here. We have so much power. These hyperscalers need power. They're willing to pay a huge premium for it. Let's just sell off the power.
That's a fascinating trend. Meanwhile, we've been talking a lot about deals and how much deals have been taking place both in the AI and the tech space, but as well as the media space and beyond. I'm just wondering how that plays into some of your forecasts. Is that a positive thing? Or is that sort of a catalyst for winners and losers that really will differentiate the winners and losers within the investing space in 2026?
Yeah, it's a very, very positive thing for us. We think that you're going to continue to see pretty strong M&A and capital markets activity into next year. I think a lot of the hesitation we saw this year was really around the public policy front. What's going to happen on tariffs? What's going to happen on the regulatory front? How quickly are we going to see deregulation? Where's tax going? I think now that we're going into next year with a little bit more clarity on that policy picture, I think you're going to continue to see some of that corporate risk-taking, a little more aggressiveness on the M&A front.
At a certain point, is the year of the adapter rather than the year of the AI tech innovator? Does that disadvantage the United States over the rest of the world? As we see JPMorgan come out this morning and say they see the emerging equity market outperforming the developed market one for yet another year after years of underperformance.
Yeah, so I think that we're going to continue to see that adoption really ramp up, and that broader diffusion is what's going to really help the U.S. market. It's been so concentrated, the return story on the enabler side, that as we see that adopter story broaden out, that will be more constructive. On the enabler side, though, we did have the announcement, so that company will see some gains there. So there's a little bit more gains to be had in the enabler side, but I do think it's overall a constructive setup.
When it comes to the real economy, is the consumer holding up?
It's been really tricky for the consumer. We held our consumer conference last week in New York, and we had over 100 companies in attendance. We got a pretty good read on the consumer from that. I think one key takeaway there was the K economy is still very much in place. We're really still seeing that bifurcation between higher income consumers and lower income consumers. I think you're going to start to see that continue into next year, but that's really what companies were talking about.
Is that what makes the Fed a little bit more complicated next year?
I think there's some complication there. I also want to bring this back to the energy story that we were talking about earlier. Affordability concerns are huge, and there's been a lot of discussion around is this demand for AI power starting to weigh on the consumer? So just bringing those two conversations together. And we found that in certain regions, that activity has really pressured consumer electricity bills. In the Mid-Atlantic, those bills have risen by about 18%, where data center activity is really concentrated.
Michelle Weaver of Morgan Stanley, thank you so much for being with us and have a wonderful holiday season. To me, this really is the key question, right? We don't have a sense of the consumer and exactly which way it's going to break, and kind of the optimism and level of it really depends on whether you see that ongoing strength.
And there's optimism right now because we just had a stellar Black Friday and Cyber Monday. You add inflation, though, does it look as rosy? And then to Michelle's point, this is why you saw the results in Virginia and the results in New Jersey. These are candidates who ran on affordability and specifically talked about electricity prices going up.
President Trump in Pennsylvania today talking about just that. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Anna and Yahaira.
Hi, Lisa. We're seeing CVS shares rising 2.3% in the pre-market. The healthcare company raised its full-year profit forecast and said earnings would rise in 2026. It's a sign of hope as it navigates a turbulent retail environment, plus government scrutiny across the healthcare industry, from vaccines to insurance. Meanwhile, Apple's chip boss is denying reports that he's leaving the company. Johnny Stroji telling staff in a memo, quote, "I love my team and I love my job at Apple and I don't plan on leaving anytime soon." Apple is undergoing its biggest personnel shakeup in decades, with senior executives and key engineers leaving the company. And Google is working to create 2 different categories of AI-powered smart glasses to compete with existing products from Meta. The company collaborating with Samsung, Warby Parker, and Gentle Monster in the hopes of creating a more refined product than its previous model, Google Glass. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahira. Up next, the morning calls, plus Jennifer Rhee of Bloomberg Intelligence on the possible antitrust concerns surrounding a deal for Warner Brothers. That's next. This is Bloomberg Surveillance.
To me, AI is for real. You have to invest a lot of money to do what this proposes to do, whether it's the data centers, whether it's all the ancillary software and the design changes to be made. But the companies that are doing it are very well positioned in terms of their balance sheet. And when they borrow money, it's probably because they rather keep the cash on the balance sheet and just use other people's money.
And perhaps because that money isn't too expensive. That was John Stoltzfus of Oppenheimer ahead of that Fed meeting that begins today, ends tomorrow, with a press conference with Jerome Powell as he indicates what he sees in the year ahead. Good morning. We're seeing right now in markets a pretty quiet tone ahead of that meeting, really fluctuating between gains and losses throughout all of the big indices. We had seen Russell 2000 outperformance. Now we're about unchanged. In the bond space, it gets a little more interesting based on some of the moves that we've seen, particularly on the long end of the yield curve. 10-year yields now fluctuating between gains and losses in terms of yields. And we are seeing just inflecting a touch bit higher after a sell-off, leaving those near the highest levels going back to September. A number of investor meetings over the past couple of hours, including Wells Fargo. Wells Fargo CEO Charlie Scharf is speaking, and he's talking about the consumer, how he is seeing a strong level of consumer spending. Listen to this: wages outpacing inflation for the customer base of Wells Fargo. Not exactly screaming this distress that so many people are talking about.
No, it sounds rosy. It sounds optimistic. Even holiday spending, they're saying it's a touch higher year over year in the first weeks. This points to, especially what you said about wages outpacing inflation, that points to a better 2026 than right now a lot of people are talking about, especially this administration. The president's going to be in Pennsylvania today because affordability has been top of concern in polls and also in a lot of the rhetoric when you hear from retailers.
Yeah, and a key question for a lot of investors heading into 2026, do you believe in the reacceleration of the U.S. consumer? Time now for the morning calls. First up, TD Cowen raising its price target on Walmart to $136, expecting profit growth to outpace sales growth. Those shares up about 0.5%. Next up, Citi lowering its target on Nike to $70 ahead of next week's earnings, highlighting ongoing challenges in China. And finally, Goldman Sachs upgrading Viking to buy, setting a strong balance sheet and large cash reserve. Those shares up 1.8%. If you're wondering, where is Jonathan Ferro? Yes, he is with Little Ferro, but he's also on a Viking cruise, cruising around the world.
I highly doubt that.
Can you imagine that? You know, teaching him about the world, out there. Yeah, maybe next year. Turning to Bay Media, and not that. The bidding battle for Warner Brothers is setting up an antitrust test for the Trump administration. Republican Senator Mike Lee, chair of the Senate Judiciary Subcommittee on Antitrust, Competition Policy, and Consumer Rights, writing, "Buckle up for an intense antitrust hearing in the Senate." Jennifer Rhee of Bloomberg Intelligence joins us now. Jennifer, great to see you. Thank you so much for being with us. So let's just start with what we understand about the regulatory backdrop of the Trump administration, given that a lot of people are talking about deregulation, a more favorable outlook on tie-ups and on business. Do you get that sense on the sign-off so far on deals that have happened?
I mean, absolutely. It's a really big difference from the Biden administration. And, you know, the interesting thing is that they kind of threw me for a loop, the new officials that were appointed by President Trump to oversee antitrust, because in the beginning, they were talking really tough. Hey, we have a lot more in common with the Biden administration than you would think, and we're going to be tough on mergers. We want to protect the American consumer. But so far, what we're seeing is they're just pushing them all through, sometimes with remedies, but for the most part, they're just not challenging these deals. And as you mentioned, when you first started to ask me that question, there's a lot more influence, I think, from the administration with respect to antitrust decisions, particularly when it comes to M&A, than there has been in the past.
I mean, the president said himself he'll be somewhat involved.
He did.
So when it comes to antitrust, can you walk us through who has a better case in front of the DOJ, Netflix or Paramount?
So my view is that Paramount has a better case. And it's kind of odd because actually when you think about it, Paramount has more horizontal overlaps with Warner Brothers than does Netflix. But at the end of the day, they're minimal. They're lower than the overlaps that Netflix has. So for instance, Paramount Plus in streaming is a lot smaller than Netflix. So when you put it together with HBO Max, those market shares are lower. The numbers, the concentration numbers the Department of Justice will look at to understand whether this could be anti-competitive are far lower. And then there's a box office overlap, but that overlap is also fairly small as well, even though there's been consolidation in that sector.
Do you think it matters to the DOJ about where the money is coming from? We're talking about three sovereign wealth funds in the Middle East, as well as the President of the United States' son-in-law's private equity firm.
It shouldn't matter. And it probably won't matter. Now, if there's a lot of non-U.S. money coming in, the Committee on Foreign Investment in the U.S. might take a look at the deal because they look at foreign investment in U.S. assets. But what I understand here is there would be no management control, there would be no voting shares, there would be no board seat. And so it's very likely that that's not really going to be a problem. Now, the Department of Justice shouldn't consider Jared Kushner, the money coming from Jared Kushner's equity fund, because they really should be just evaluating this based on the antitrust laws, and that is it. But it obviously could influence how President Trump sees it, and then that could result in pressure being put by the administration on the Department of Justice for a certain outcome.
You know, you could argue that actually Netflix has a better case when it comes to the antitrust battle because of the tie-up of the news organizations in particular, especially given some of the controversy of late with the administration hoping for a change in direction in different places. I mean, how does that factor in? The fact that Paramount would be bidding for CNN and for CBS, bringing them together potentially, whereas the Netflix deal would really separate the two.
Right. You bring up a great point that I actually should have mentioned before when I was talking about the overlaps. Not only do I think that overlap in news could be problematic, I think an overlap in a giant package of cable networks that the company would have could be problematic. But that kind of issue is really easily fixed. That's through divestiture. So in a normal situation, what I would expect here is the Department of Justice would probably ask Paramount, if it's the buyer, to divest CNN. But on the other hand, the administration might be more interested in CNN staying in the hands of Paramount, right? Because it's the Ellison's family, and the Ellisons are aligned with them. So in this situation, maybe that wouldn't happen. But I could see them asking the company to divest some of the cable networks, because when they have that big a bundle, it gives them a lot of leverage over distributors.
I wonder, if you take a step back, how difficult it is to really understand what a monopoly is at a time when industries are so profoundly changing. The idea that Netflix could argue that their big competitor is YouTube, not necessarily one of the other streaming networks, one of the Paramounts or the like. So how do you sort of think about what the competitive landscape is at a time where our attention is being split into different places?
That is a really, really good question, because that's what it's going to be all about. And that's actually what most merger arguments are all about. How do you define the market? How do you put your arms around or put your circle around the sphere of competition? Who's in and who isn't? Because that's what dictates market share, and that's what dictates market concentration. Netflix will absolutely argue that the market is broader, that it should include any kind of video, anything that's taking the attention of eyeballs where somebody's watching video, whether it be YouTube or TikTok or just standard old-fashioned television, right? But the way the Department of Justice looks at this, and they actually use really complicated econometric modeling to try to figure this out. They have economists on staff, and they look at it from a consumer substitutability perspective, right? They ask if a person subscribes to a service or product, they don't like the price, they don't like the quality, and they want to switch, what will they switch to? And anything that they might switch to gets included in that market. And when the consumer doesn't switch, and again, this is done through economic modeling, that defines your market. And I think there probably is a pretty good argument that at least for some class of consumers, they wouldn't view something like YouTube as a substitute for streaming video on demand.
Jennifer, what's the timeline? When do you think the DOJ would wrap this up? Once Warner Brothers chooses their partner?
Yeah, once we have a deal, once that deal's filed, I think you're looking at a year or more. These things take a long time. They do an investigation. They issue a big subpoena called a second request for information, asking for data and documents. They have to Companies have to turn those over, which takes a long time. The Department of Justice has to digest it. And then they go in with the economists and they make arguments in defense of their deal. And it really does tend to take about a year, sometimes up to 18 months.
Jennifer Rhee, wonderful to get your thoughts.
Thank
you so much for being with us. That's Bloomberg's Jennifer Rhee on the latest in the antitrust issues surrounding this case. Meanwhile, we are getting some weekly ADP employment data that does inflect the positive. Michael McKee of Bloomberg joining us now for more. Mike, what do we see?
Well, we see that ADP in the 4 weeks leading up to November 22nd, that the economy added, according to ADP, an average of 4,750 jobs, which is an improvement over the 13,000 or so that were lost to the average week before. But the problem is we don't exactly know how to use this. The Fed's been using this data for quite some time, which helps them, in the absence of the non-farm payrolls numbers, at least get a sense of where the economy is. But when you have wide swings like we've seen in the last couple of weeks in terms of these 4-week averages, it's hard to know exactly where that leaves you for the end of the month. And we're going to have to wait until next week, unfortunately, a week from today, before we get the next payroll numbers from November, and we won't even get all of the October numbers. So make of it what you will. It's a little bit better news, but it doesn't necessarily tell us what we saw in the month of November.
Michael McKee, thank you so much. This would be the first positive read from this new ADP report after 4 straight weeks of negative reads. We also are seeing something about the small business front. This is something that ADP points out, saying that in general, smallest business establishments lost 120,000 jobs in November, while medium and large firms added 90,000 jobs, sort of speaking to that K-shaped market within corporate America.
At least, though, to Mike's point, this is direction of travel better based on what we had previously heard from ADP. So they are adding more jobs on this weekly basis. Does it move the needle for the Fed? I don't think so. The Fed is still somewhat in a fog. And as Mike says, we're really not going to get a little bit more of a clearer picture until next week.
Which is the reason why people are looking for potentially getting some information that is delayed from non-farm payrolls. Coming up, we'll talk about that and what the Fed will do with that with Jonathan Pingle of UBS with that December FOMC meeting kicking off today. Plus, Danny Berger with your morning movers. Another check on Paramount as the company goes all in on Warner Brothers. Those shares up 0.2% in markets more broadly. A real question of long-term bond yields and how much they've climbed over the past couple of sessions. Do they continue that ascent as the global bond sell-off takes hold right now in markets fluctuating between gains and losses as people ratchet back some of their expectations for next year's Fed rate cuts? From New York, this is Bloomberg Surveillance. Right now, you've got stocks fluctuating between gains and losses. The futures a little changed across the board. There had been the outperformance in the Russell 2000. Do we continue that heading into the Fed meeting? 2s, 10s, and 30s. So much depends on that long-term bond yield after the sell-off that we have seen. A question around the global influence versus the domestic one on the front end of the yield curve. You have seen a bit more of a skepticism in terms of how much the Fed can cut rates. 95% chance that they are going to cut in tomorrow's announcement. At the same time next year, ratcheting back those expectations, a little bit of a bid coming in to the long end. 1 hour away from the cash open. Here are your morning movers with Danny Berger. Danny.
Hey, Lisa, it's the drama between Paramount, Skydance, Warner Brothers, and Netflix. You're looking at Paramount, Skydance. Those shares are up about 0.5%. They were up more than 1% in the pre-market trade just moments ago, but it does seem like the odds keep shifting around who will be buying Warner Brothers Discovery. The latest on Polymarket has them in the lead with this new bid, and we've learned about the backing, a lot of Middle Eastern sovereign wealth funds, Jared Kushner's affinity, and the Ellison family. Meanwhile, some reconstitution for the S&P 500. We've learned that Ares is going to be added to it. It gets a lot of passive flow when companies get added to the S&P 500, so those shares up 7.7%. Kellanova, that will be kicked out. Finally, ending things with Home Depot. Around 6 a.m., we got an update from Home Depot on their investor day, saying that they expect for next year comparable same-store sales to be between 0 to 2%. That does not suggest that a recovery is on the way. And with that tepid forecast, shares are dropping by 2.6%, Lisa.
Thank you so much, Danny. Of course, they did give a rosier scenario, but said they haven't seen that rebound in the housing market just yet. Meanwhile, the FOMC's 2-day meeting kicking off today. President Donald Trump issuing a test for the next Fed chair.
You're going to pick a new Fed chair soon. Is it a litmus test that the new chair lower interest rates immediately?
Yes. Well, this guy should too, but I think he's a combination of not a smart person and doesn't like Trump.
Michael McKee, Bloomberg economics and policy correspondent, joins us now for more. And Mike, we are going to be talking about ad nauseum the race to be the next Fed chair. A question, though, about how much clout Jerome Powell still has in his meeting at the end of this year tomorrow.
Well, I think Powell still has enormous respect from members of the Open Market Committee. And even if we get dissent, it's not going to reflect necessarily on him, but it will reflect on the circumstances. The issue with the president's comment today is he's setting his Fed chair nominee up for sort of a walk-in-the-door failure, because the markets are going to look at the guy and say, at this point, we don't trust you because you're there to do something the president wants rather than what the economy tells you to do. That's been something that Kevin Hassett, who is the betting favorite, has tried to talk down. And here's the president seeming to undercut him a little bit.
Yeah, which is the reason why it's notable that yesterday when Kevin Hassett was speaking, he actually really diminished the idea of giving some sort of 6-month plan of how much he planned to cut in the first half of 2026 should he become Fed chair. There is a feeling that whoever becomes the head of the U.S. Central Bank has to build credibility in markets and on the Federal Reserve Committee.
Absolutely. And that's going to be a real test for anyone that President Trump nominates, because he's been so firm in criticizing the Fed and criticizing Jay Powell. We don't know whether Powell is going to stay on the Fed or not as a governor if he's not chair anymore. It's a bit of leverage that he has over the president. He has suggested to people that he might stay if he doesn't think the new Fed chair has credibility or could do damage to the Fed. So that's going to be a political question to watch going forward, along with the whole question of whether or not the president's going to be able to fire Lisa Cook, a decision that would probably come after Powell is gone. But if the president was able to do that and Powell decided to leave, then Donald Trump would have a lot of space to fill spots on the Federal Reserve Board.
Michael McKee, thank you so much, and we look forward to catching up with you throughout the day and tomorrow, certainly, as that Fed meeting concludes. We are hearing from Kevin Hassett yesterday. He did say that the Fed chair's job is to watch the data and to adjust and to explain what they're doing and why. He also went on to say that to say, I'm going to do this over the next 6 months would be irresponsible, even though people have talked about a 6-month plan for any Trump appointee.
If he is the front runner and he knows he's going to get the nod, he's setting himself up to gain more of that credibility, as you said, with his committee members. I'm not coming in here wanting to cut interest rates every single meeting. We have to look at the data, how the economy is digesting all of this, and then make decisions that make sense for both sides of their mandate.
Well, let's stick with the Fed's head of tomorrow's rate decision. Jonathan Pingle of UBS writing, we expect a large majority of FOMC members to support a 25 basis point rate cut. Expect few changes to the dot plot and no change to median assumption of appropriate policy. Jonathan joins us now. Good morning, Jonathan. Thanks for being here.
Thanks for having me.
So let's just start with a question of what you expect to learn tomorrow if you don't think we're going to get any adjustments.
Well, I think we are going to get a certain amount of communications out of Chair Powell, assessment of the risks, how he's viewing the outlook, what kind of bar he might have in mind for future cuts. The market's been pretty anchored to sort of having the year-end target range kind of around 3% at the end of next year. I think a lot of that is the discussion you were just having on the next Fed chair. But I think for the remainder of Chair Powell's tenure, he still is balancing these mixed signals. I mean, you just heard the Home Depot news. He's got kind of weak residential, weak non-residential, kind of weak, soggy labor market. How does he balance that against the inflation? I think those are going to be important questions to assess as we go through the press conference tomorrow.
How different is it that we might see 4 dissents for the first time going back 30 years on the FOMC committee?
Well, it's not that unusual historically. I mean, if you look back and you think about sort of the Greenspan era, where Chairman Greenspan really, with a lot of manipulative skill, I would add, having watched him, really controlled the committee. And then you had, sort of the GFC, the Bernanke era, where, Ben was just the extraordinarily correct scholarly choice for the moment. And then you had, the pandemic and the inflation. So it was sort of an era where, there were sort of a lot of all hands on deck moments. So I'm not surprised we haven't seen a lot of dissents lately. But if you look historically, dissents are really the norm. It's unanimity is kind of the exception. I also think Chair Powell's, I'd bet he gets fewer than 4 dissents. And I mean, and you were talking about the clout earlier. What kind of clout does he have at this point? I think it's more earned respect. I mean, he's the one who's been pounding the pavement up on Capitol Hill. He's the one who is being, tweeted about. He's too late. Do you know what I mean? Like, I think he's really done a lot to incorporate the views of his committee. I think at the end of his tenure, he's just kind of earned some deference at this point.
As an institution, though, actually, don't dissents show the credibility that this is a deliberative body and it's not, we're just going to all line up where the chair is, at least for the future, if you are concerned about potentially someone that is very close to the President of the United States?
Sure. I mean, dissents are super healthy, but you also don't even need the dissents, right? I mean, we can hear Beth Hammack, even though she's not a voter, she's not going to dissent, but she disagrees with this policy. So you certainly do have that kind of open debate, and that's something that's certainly I think going to play out and remain a feature for the next FOMC as well next year.
So when you look into next year and the next FOMC, how many cuts do you have baked in for next year, and does it matter who the Fed chair is?
I have 2.
For the cuts.
And yes, it does. Yes, it does, I think, matter who the Fed chair is. I mean, we're all talking about Kevin Hassett. I mean, I've known Kevin for a long time. And Kevin actually has, in terms of his ability to build credibility, he's got, I think, kind of 3 key features that would make him sort of an effective Fed chair. One is his academic publication record's pretty impressive. If you think about the peer-reviewed journals he's published in, he has incredibly well-cited papers. Second, he was on the board staff and is an incredibly astute data expert of himself with knowledge of a lot of that staff and how they use the data. And third, he's really, Kevin's nice. I mean, he's really collegial, right? I mean, I think that will go over well in terms of trying to work with his colleagues. But I also think that combination is going to help him win debates at the table.
So we talk often about Fed policy as being rate cuts. But when we talk to equity strategists for 2026, they talk about the use of the balance sheet. They talk about quantitative easing in another name. And we hear that from Morgan Stanley. We hear that from Bank of America. We hear that from BlackRock, the sort of monetization of the debt that already is transpiring with respect to a focus on T-bills and the potential purchases disproportionately on the balance sheet. How much are you looking for that type of activity in the background, regardless of potentially a tempered view of how many rate cuts this Fed can make?
Yeah, I know. I'm expecting them to start outright expanding their securities holdings in January. And a lot of that is, though, I think, if you look at the level of reserve balances and what's happening in repo, it does look like it's starting to get a little tight. So I do think that they are going to have what they would call a reserve management purchase program. Regular purchases of T-bills, I think they probably start around $40 billion a month, but I think that's probably going to have to get up to 60 by the end of the year. Really just because they've got other liabilities that are rising over time. You clearly seem to be sort of in this ample reserve regime where you're putting upward pressure on the effective funds rate. I mean, the spread to IORBs narrowed steadily over the last month and a half. So I do think they're at a point they need to actually start adding liquidity instead of draining.
Which is what a lot of people are mentioning. And they say that the sell-off that we saw in big tech was largely driven by the withdrawal of Fed liquidity reaching that tipping point of reserves. I'm just wondering how much is this a technical issue in the markets and how much is this outright asset buying and monetization of the debt?
So there is an element of monetization of the debt. I'm skeptical at how much that's driving high-frequency equity market moves. I mean, it is the case that if you have more volatility in repo markets and higher repo rates, you're going to have higher costs for funding leveraged positions in equity markets. But, I think what's happening in the background of the Fed balance sheet is they've kind of gone too far. They need to reverse it. But I don't really think this is going to be some sort of flood of additional liquidity. I think they are going to try to temper how much they are actually adding. And I think the risk is they probably err on adding too little.
Okay, so if that's the case, I guess how do you game out the idea that we might see Fed rate cuts in addition to fiscal stimulus, in addition to a reaccelerating U.S. consumer at a time where inflation has still been relatively sticky. Do you see this as creating a problem for the 10-year and a Federal Reserve that might be motivated to try to cap some of those yields?
I don't think it's going to be that much of a problem for the 10-year, mainly just because we are getting some good news on the forward inflation indicators, right? I mean, if we look at the composition of inflation right now, we're seeing sort of core goods, ex-used cars sort of turn up. You can see the tariffs slowly passing through. But the forward indicators that we're getting on things like the slowing in rents have actually really gone the Fed's way. We've got among the higher estimates of inflation on the street. But by the second half of next year, we're still back to 2.5% or below on annualized run rate. So, the Fed's sort of got some tailwinds here on inflation. The Fed credibility, we'll see how much they try to push rates lower. But I do think that you'll start to hear a much more credible case about the supply side, and in a way that I think it'll alleviate at least some investors' concerns over whether this is really going to be sort of a FOMC that runs amok.
So you don't agree with the hawks about the concerns about inflation, but how do you view the labor market next year?
Well, I'm sympathetic to the hawks' argument. I mean, they haven't hit their target in 5 years, right? It's going to be going on 6. Right, yeah. At some point, it's going to look bad if inflation does stay sticky. But I do think they face a problem with the labor market. I mean, you've had residential investment contracting, structures investment, government spending and investment, even without the shutdown, has been unusually weak for the U.S. And consumer spending's been mixed, right? I mean, upper income's doing well, but we're seeing other parts that aren't. So the labor market is weak for a reason, and if the labor market turns into more obvious contraction, you really could have households pull back in earnest. So, thinking about sort of Chair Powell's risk management framework, the potential cost to the economy of, an unemployment rate that doesn't stop going up, I can see why he wanted to kind of address, there wasn't a whole lot of reason to slow the labor market when it's already weakening too much. And there's not a lot the funds rate's going to do to stop the cost push inflation of tariffs. So I do think his calculus makes a little bit of sense.
Jonathan Pingle, wonderful to see you. Wonderful to have you in studio, and hopefully we'll see you soon. Jonathan Pingle of UBS joining us here. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief, Yahira Anand. Yahira.
Hi, Lisa. Paramount Skydance launching a hostile takeover bid for Warner Brothers. The move coming just days after the company agreed to a deal with Netflix. The offer stands at $30 a share in cash, compared with Netflix's cash and stock bid of just under $28 per share. President Donald Trump, whose son-in-law Jared Kushner is participating in the Paramount bid, is downplaying his involvement, saying he's not close to Paramount nor Netflix. Meanwhile, President Trump granted NVIDIA permission to ship its H200 AI chip to China in exchange for a 25% cut of the sales. The move means the world's most valuable company could regain billions of dollars in lost business. The president says that the sales would only go to, quote, approved customers, and that chip makers such as Intel and AMD would also be eligible. And PepsiCo announcing a series of operational changes backed by activist investor Elliott Management. The moves include cutting nearly 20% of its U.S. product lineup, investing in more affordable products, and planning layoffs in North America. Elliott says the plan will drive greater revenue and profit growth. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahira. Up next, setting you up for the day ahead. Plus, Bloomberg's Ed Ludlow as the White House reverses its stance on selling NVIDIA chips to China. You see NVIDIA shares and AMD shares rising in response. This is Bloomberg Surveillance.
There's been so much back and forth on this, and my recollection is that the H200 chip was one that was actually developed specifically to be exported as opposed to some of the other chips. I think that there is an argument to be made on both sides, one for security and one also for you want the paradigm to be the technology that we are exporting as opposed to letting people develop technology.
That was Sarah Hunt of Alpine Saxon Woods on NVIDIA exporting H200 chips to China after President Trump reversed his stance on it. You did see NVIDIA shares and AMD shares rising in pre-market trading as a result of that. Intel also potentially included, although not necessarily participating as much based on just what their export models could be. S&P futures fading throughout the morning, had been up almost 0.1%, now lower by less than 10 basis points, so not a significant decline. Nonetheless, really a focus on what we get from JOLTS job openings later this morning and what that means for the Federal Reserve. 10-year yields a little bit lower by about 2 basis points after that ADP data came out, 4.1468%. Meanwhile, what we are focused on right now, counting down to the opening bell, your trading diary for the week ahead, those 10 a.m. Eastern October JOLTS data. Tomorrow at 2 p.m. Eastern, we get the FOMC rate decision, followed by Fed Chair Jay Powell's press conference, employment cost index before that, plus earnings from Oracle after the closing bell. Thursday, another round of jobless claims, as well as earnings from Broadcom, as well as Costco, a real question about how they're lining up with the tariffs. Friday, we finished the week hearing from Fed Presidents Anna Paulson, Beth Hammack, and Austin Goolsbee. Turning back to one of our top stories, President Trump allowing NVIDIA to sell its H200 chips to China. Bloomberg's Ed Ludlow joins us from San Francisco with more. Ed, how much of a reversal is this in Silicon Valley, given the fact that it seems like there is a shift in the approach to national security?
As a point of export control policy, a big shift. And, I think even Bloomberg Economics published a note on it, which I enjoyed reading because the H200 is a piece of technology at the center of export control policy. The soundbite that you played from your last guest is interesting. What is the H200? It is many times more powerful than the H20, which was specifically designed as a deprecated chip for the Chinese market, right? And this is a debate the three of us have discussed this week and many weeks prior, that the position of NVIDIA and Jensen Huang has been, it won't work to export a deprecated chip to China. They won't accept it. The H200 is a cutting-edge chip. It is one generation removed from Blackwell that's available to technology companies in America, but it's highly performant. And so it does mark this shift in the spectrum of China hawkishness. We've gone from a position where loads of people in the president's orbit are okay with exporting a deprecated chip to now being okay with exporting a more powerful chip. But of course, across the political divide, there are many national security concerns, and the ball's now in China's court because we don't really know if China even wants it.
Right, that's a big question. Does China even want it? The Financial Times has some reporting that potentially they're going to have a review process and some firms may get access to it if they can show the reasons why they need this instead of using a Chinese company's chip. But Ed, if NVIDIA is able to sell a lot of these H200s into China, or China really opens up the door, what kind of money are we talking about for the bottom line?
Yeah, look at the trading of NVIDIA shares in the immediate aftermath of the president's Truth Social post through to this morning. And momentum was lost very quickly. The baseline assumption for NVIDIA right now is zero revenue from China within this fiscal year and in next fiscal year. But of course, when this news hit, the analysts quickly remodeled to work out how much revenue is possible in China. Jensen Huang has said that this is a $50 billion market opportunity. But the issue is the degree to which they can work with China on that. You're right, the reporting reflects that China's position is to say, particularly to state-backed enterprise, we want you to first prioritize using domestic chips that are massively supply constrained before using the H200. So again, NVIDIA's baseline assumption is zero revenue from China, although they'd love it. And now the analysts between them have a very wide range of estimates of what's realistic in the fiscal 27 year.
All this is in exchange for a 25% tariff. But Ed, I remember in the summer, there was that 15% that was supposed to go to the U.S. government. Has the U.S. government seen a dime of that?
No. And it's interesting. You will remember in August, I spoke to NVIDIA's CFO, Colette Kress, who is a classic CFO, a very experienced CFO. And she made the point that they are an American public company. They are bound by SEC regulations and by the Sarbanes-Oxley Act. And there is nothing codified or in existence in the legislature that provides for a mechanism where a company can issue a surcharge to the United States government, in this case of 25%. So my basic working understanding is that, of course, this is the discussion that's taking place between the president and Jensen Huang, but we need to see some specifics from the relevant regulatory agencies and government bodies on how it would work in practice. There are going to be loads of compliance and finance teams watching surveillance right now going, oh, I was thinking that as well, I think, because that's the basics of how a public company works in this country.
Ed Ludlow, thank you so much, as always, for the insights in this developing story with a real focus on big tech and how much it can continue to drive the economy. Right now, our focus is very much going to shift to what we get from JOLTS job openings data. We did get this ADP report earlier this morning. As Mike was saying, hard to know what to do. It's a new series of data. Nonetheless, this really stands out to me, the focus on small businesses, with ADP and coming out and saying that last week's ADP National Employment Report showed that small business establishments lost 120,000 jobs in November, and medium and large firms added 90,000. This is a tale of two corporate sizes, and this is what we hear across the board.
Well, this is what Neela, who is at ADP and our Bloomberg contributor, said to us last week. She was concerned about what is going on in the small business space, not these big executives. And Jean Seroka, who's running the Port of LA, was talking about how it's these big retailers that are able to mitigate all the supply chain disruptions, all the concerns around tariffs. It's the small businesses. Those are the ones that are having a lot of issues when it comes to margins, and potentially that's why they're laying people off.
And that's the reason why the Fed is having a hard time getting their hands around this, because on one hand, you are seeing big companies do just fine. You aren't necessarily seeing the price increases, but you are seeing job losses in some key areas. We do get that Fed meeting kicking off today, finishing tomorrow with the press conference, widely expected to be a 25 basis point rate cut at tomorrow's meeting. The look ahead could be really interesting. Kevin Hassett in the front seat in terms of who's going to be the next Fed chair. In his interview yesterday, really talking about how he isn't going to give some sort of sense of how many rate cuts he's going to give. He really is going to be data dependent.
Right, but that's the one question the President of the United States is going to ask. And we know this because this is what happened in his first term. Are you going to cut interest rates? That's all he wants to know. Kevin Hassett might be able to say, I'm going to cut them at the next meeting. At least that's where my vote would be. But I can't tell you where I'm going 6-12 months' time. He's clearly trying to build credibility for potentially his future colleagues.
Right now, we're looking at markets that are trying to discover some sort of Santa rally. Coming up tomorrow, Julian Emmanuel of Evercore ISI, Erica Najarian of UBS, Chris Harvey of CIBC, and Chevron CEO Mike Wirth with huge demands on the energy sector. This was Bloomberg Surveillance. Good morning.